Did you know you can get a copy of the Edge Finder completely free with our sponsor, 8cap? 8cap is a super well-known brokerage that has been in the game of CFDs for a long time. And if you are interested in switching your brokerage to 8cap, they can actually purchase a copy of Edge Finder on your behalf, making it completely free for you. This is an offer our team has worked out to make the Edge Finder a completely free to access tool if you move over your account to 8cap. Here's how this works. It's pretty straightforward. If you head over to our website, a1trading.com/8cap, you can explore this offer in more details, including all the terms and conditions. But basically, the high level idea is if you create an account through that specific page and you meet the deposit requirements, 8cap will effectively buy a copy of Edge Finder for you. Now, please note this is unavailable to US traders, but for my friends outside the United States who trade CFDs and you like the brokerage 8cap after exploring it on this page that is linked below, then maybe you consider taking advantage of this offer. We've had a lot of people do this and it makes the Edge Finder completely free, which is a hard price to beat, by the way. It doesn't get much better than free. And it's a win-win-win. 8cap gets a new client, you get a great brokerage, as well as access to our software, as well as other stuff on that page. You can get access to free memberships with us, Stockbox, etc. at no cost to you. You just move over your trading to 8cap. So the full details and terms and conditions can be found on this landing page, again, linked in the live stream chat or in the description down below. Please also make sure to do your due diligence to make sure that 8cap is a good fit for your trading and meets all your criteria for what you're looking for in a brokerage. On this landing page, you can explore the different product offerings that you get access to from our store completely free if you deposit certain tiers within this list. And the cool thing about this multifaceted offer is that even if you have a lower capital basis, why not move your account over if you like the brokerage, you like what you see there, and get something for free out of it. I think this is a really cool offer that they've set up with us, and it is sort of a co-branded offer by 8cap sponsoring A1 Trading. So check them out. Again, all the information can be found on that landing page, a1trading.com/8cap, or found in the description or live stream chat below. Thanks to 8cap for sponsoring. Now back to the stream.
Hello traders. Happy Wednesday. Hope you're all locked and loaded and got your seatbelts on for FOMC tonight, the interest rate decision. We got Fed Chair Walsh coming on. No longer Powell. It's a bit sad. It's the end of an era. It brings a tear to my eye. Anyway, let's get some votes in the chat before we go forwards. What are we expecting? Let's do cut, hold, and hikes. What do you guys think we're going to get today? I know we've got Alan, Tiger, good to see you both. Sluggy, hello guys. That's almost the wrong word. Hope everyone's well. So what do we expect? Dollar should pump. Why is the question. Hawkish hold. Yes, Sluggy. I think I might have to agree with you on that one. Florian, hello. So hawkish hold. Yes, I think we're all on a similar page, I would assume. So before we go forwards, I think we should probably do the most appropriate thing, which is checking the CME Fed Watch. So what do we have priced in? 99.6% probability of a hold today. I don't think there's really any second guessing that we're going to get a hike or a cut. You know, I don't think that's a probability at all. However, in July, we are starting to see a hike priced in at 8.9%. However, the majority is still at hold at 91%. Then in September, we have a 29% probability of a hike. So what we're seeing is the market's beginning to price in, or somewhat pricing in, a hike by the end of the year. So when we're looking at the Fed Watch tool, what you need to understand is it doesn't mean when we're looking at this and we say, you know, it's 29% probability of a hike in September, it doesn't mean they're expecting a hike in September, another hike in October, and another hike in December. It's all sort of priced in the future, if that makes sense. That's probably a topic for a separate stream, but something we need to understand about the Fed Watch tool. So yes, extremely likely we just get a hold, but then that's not really what we want to pay attention to. I mean, obviously it is, but the main event is the forward guidance. What do we get from the Fed in terms of expectations going forwards? So I think the idea of a hawkish hold is the most likely. So this is the first time we'll hear from the Fed since we've had the peace agreement headlines come out about Iran and the US. And we've got data in the US that is quite supportive for a hawkish hold. So if we look at the economic heat map for the US, the only real thing that might be a little bit more of a dovish take is the growth. So GDP growth quarter on quarter here did have a surprise to the downside. So the actual came out at 1.6, the forecast was 2, which is a bearish impact on the US dollar. So that might be something that we could lean on. But then we look at inflation. So CPI, PPI, and PCE, there's not much here. We're actually seeing more of a sticky inflation environment. And then we look at the jobs market down here. So unemployment, wage growth, jobless claims, JOLTS, ADP, and NFP. The only real negative here is the jobless claims. Other than that, we're seeing a relatively resilient labor market within the US. So I don't think there's really any room for the Fed to go dovish, but I also wouldn't say we're going to get a super hawkish forward guidance. I would expect it to be more a case of wait and see with that slight hawkish undertone. Right, what are you guys saying? My expectation, oil up, dollar up, gold, silver down, euro, pound down. The reason for that is war flaring up again, Lebanon issue, Trump comments on MOU, fragile, Wash will be hawkish despite hold. Yeah, I mean, we've all got a similar expectation about the hawkish tilt. Cyclical dollar bid knows something's coming. Yes, that is also something very true. So if we look at the US dollar on the weekly time frame, we've been talking about this for the past year, but every time we get down to this level of sort of support, this trend line, whatever you want to call it, it doesn't really matter whether you trade trend lines or not. This is something that I think almost everyone is looking at. But every time we get down to here, we do have that bullish cycle or the bullish run, whatever type of terminology you want to use. But every time it happens, it happens without fail. And this has been happening since sort of 2007, 2008, give or take. Now, the dollar has been range bound for the past year. We've not really seen anything happen. Of course, intraday and noise and so on and so on. But generally speaking, for like a swing trader's sort of trend, this is an absolute nightmare. There really hasn't been much we could do with this. So if we do get that hawkish Fed to come out, we do see the hawkish Fed, it could be a catalyst for the dollar to start that bullish cycle and start coming up towards 105, maybe start creeping towards 110. We will see. But of course, what we don't want to do is put all our eggs in one basket. You don't want to go into position saying, I think the Fed's going to take a hawkish stance. We're going to get all these rate hikes or even one rate hike go super bullish on the dollar. And then it turns out that actually that doesn't work out by next month. And now you're massively underwater by buying the dollar. Of course, I'm not saying that's likely, but I'm just saying, keep yourself safe. Am I still in Aussie New Zealand short? No, I'm not. I liquidated that position earlier this week. So Aussie New Zealand here. So actually, this was a position. So we had in fact, was this what we marked up yesterday? I can't remember. But it was very similar to this. I think it actually might be this. So initially, it started off terribly with this, this move to the upside. Then it corrected. And, we had the hawkish pivot by the RBNZ, and it worked out quite well. But then we saw a very quick correction to the upside, came back towards entry. I was like, okay, no problem. This was a fib zone with it. We measured this high to this low. This was a reasonable pullback to see, so I was happy to hold it. Then we failed to create a lower low, and we started pulling back. And I just felt uncomfortable. I didn't want to hold that trade anymore. Fundamentally, I wouldn't say it was the best trade, but I wanted to bank on more of a mean reversion style trade and an unwinding, which hasn't proved to have worked so far. So yeah, I took a little bit of a loss actually on the swap fees. So I closed the trade roughly around here, but because I was holding back here, and this is obviously a positive swap market, for this whole duration of the trade, I was paying money. So yeah, it was actually a slight loss. Obviously nothing crazy, but yeah, overall a net negative trade. What do you think the Dow Jones will do? I would expect, actually, this would be, in my opinion, the most typical sort of market dynamic. Maybe not, it's not the right way of saying it. I'm not sure what the right wording is here, but in these markets like the Nasdaq and the S&P, how often do you see these types of market gaps go unfilled? I would say next to never. It might, could take a day, could take a couple of days, could take a couple of weeks. I would expect this potentially hawkish Fed to drive the S&P, the Dow, the Nasdaq lower, correct this gap, and that would be a catalyst, for a gap fill. Now, I'm not saying the Fed's going hawkish or going to say anything to cause that specifically, but I'm saying it might be sort of a byproduct of that. Visa longs, very nice, Ray Beast. Watching AUD USD shorts. Yeah, so I'm short actually on pound dollar. I've reinitiated this one. So the fundamentals aren't really there. So if we check the Edge Finder and we take a look at the pound Aussie, I made a YouTube video on this, by the way, this morning. So I'm not going to do a super deep dive on it. Excuse me. But the fundamentals aren't there. So this isn't a typical trade where the Edge Finder is bearish and then we follow the trend. This is more of a idea. I'm banking on the UK economy to continue to do incredibly poorly. And I'm also banking on the rate advantage as well. So if we go back to the Edge Finder and we go to macro scanners and we go to carry trade scanner, this is super useful. So pound Australian is nowhere here. Let me search it here. So because the Bank of England has a lower interest rate than the RBA, which is the Central Bank of Australia, there is actually, I suppose this would be a negative 0.6% divergence, meaning that we actually get paid to be short sellers, which is very nice. So we're getting paid for this trade, and I think overall it's pretty okay. Weekly time frame is looking quite bearish. Daily time frame is still bearish. And we rejected this level of structure. It's not a great level, but it is there if you really look. And on the daily, this is a pretty decent fib pullback as well. So it's against what I've been talking about recently about the Australian dollar weakness, because that hasn't proved to have worked. So now I've actually flipped bias, and I'm more going with Australian dollar resilience, because we also have another hike that's expected by the end of the year for the RBA, and also on the sterling weakness as well. Hold on, I think I've missed some messages. Okay, no, I haven't. That's cool. So yes, pound Aussie short. I'm still short on the pound dollar, and I actually added into this one a little bit. So I've got about 2% risk on this trade now, because I like to round up. So I normally enter with about 1%, depending on the stop loss size and the quality of the trade. But typically speaking, I'm happy to take 1% risk, and then I'll add another 1%, because my budget really is 2% per trade. That's very aggressive, and it's not every trade, but I'm happy. That's kind of my max allocation. So I'm happy to add in, which is what I've done. And I'm now just banking on the idea that Eurodollar is going to continue lower. We've got incredible bank forecasts. So largely speaking, we're looking for about 1.12 on Eurodollar. I keep saying this. I don't want to say worst case, because that makes it sound like it's guaranteed. But the highest target we've got by institutions at the moment is 1.14. So even if this trade doesn't deliver the full target, it would still be a pretty nice sort of 2% return. Well, 4-ish actually for my positioning, but 2 in general. And gold long, which has done absolutely nothing. So gold is an interesting one, because first of all, it's quite a nice hedge for my Eurodollar position. So obviously, if we get dollar strength, it's going to benefit Eurodollar, which can continue lower, which I've got more money on the line with, as opposed to gold. So if gold hits stop loss, it's completely fine, because Eurodollar will cover that with no problem. However, if this trade does work out, that's great, because I've got quite a large target. We've got Credit Agricole looking for about 5,420 on gold. So yeah, that's pretty nice. So I'm happy to stay long gold for now. AUD NZD, then based on what you said, go long? No, because I'm also not bearish on the New Zealand dollar. So Aussie New Zealand for me at the moment is just a no-go. As I said, I was looking for more of a sort of breakdown in that market. I really wanted to see the lows getting broken and more momentum to continue, but it just didn't happen. So, sometimes you've got to just realize that the idea didn't play out. That doesn't mean that I'm bullish on the market. It just means that I don't have that bearish bias as I previously did. Visa is best trade of the year. Took a long at 290 April, closed at 345 and 3 more position. Ray Beast, that's fantastic. I'm very happy for you. Thoughts on silver? Silver is actually looking really good to go short. So Actually, let's see what the Edge Finder is saying first. I'm not sure if silver's on the Edge Finder in terms of the top setups. I don't think it is. We'll see. We'll see what it's got here. I can't see it. Let's search it. There we go. So silver's actually got -7. Maybe I missed it on the top setups. So fundamentally speaking, we want to go short silver. And that's, again, just based on the Edge Finder, which is a pretty good way to just find a direction very quickly, and a reliable direction at that. So if we know we want to be short sellers, or we want to have the short bias because the fundamentals are pointing that way, I would ideally like to see silver come a little bit higher towards a 61.8% fib retracement. And the reason specifically that level is because it lines up a little bit better with this previous support that we've broken. So that will provide not just the break, the retest, but also a pretty nice fib pullback as well. And we've still got the bearish trend here with the 250 moving average. So technically and fundamentally, it looks great to be a short seller. The problem I've got, though, is I'm not really sure if I want to be bearish, which is why I bought gold, because we've got yields coming down. So if we look here on the 2-year yields, let me pull these up for you. We can see these are starting to cool off a little bit. Excuse me. And we're seeing the same thing on the 10 years as well. 10 years are down, so, or at least coming back down. And also we've got the Fed tonight. So it's a case really of what's your outlook? Do you think we are going to get a resurgence in tensions in the Middle East, or not even tensions, but, you know, war, and oil blockade and all that type of thing continue? Or are we going to get a resolution where the peace deal is signed on Friday? If so, if we get the peace deal, I would expect metals to start climbing higher. And then also, again, we've got to account for the Fed, which is tonight. So yeah, it's a big sort of wait and see. So my position on gold is not based on fundamentals. It's based on what I think is going to happen really in the Middle East and maybe with the Fed. Not so much the Fed, actually, because that one's more of a euro-dollar position. But hopefully you get what I'm trying to say with that. I know that was maybe a little bit of information vomit, but I tried to make it make sense in a short amount of time. So I've got about 10 minutes left. So if there's any chart requests, let me know. If not, we can keep just having a look through. So I've already covered these ones. I'm also long on the Australian dollar Swiss. This is also more of just a carry trade idea. The fundamentals don't support this one either, actually, I don't think. Let me just double check. I'm fairly sure the Edge Finder is bearish on Aussie Swiss, if I remember correctly. Yes, it is. So Aussie Swiss is getting a bearish reading. But again, with the Aussie Swiss, I'm not really taking a actually, hold on. Sorry, I've just seen. This isn't necessarily a fundamentally bearish market. So it is if you sort of really simplify it and we say, oh, economic growth is bearish. Okay, fine. But the jobs market is neutral. Inflation is neutral. I personally don't really care too much about COT. And I don't really care about the technical signals either, because I find the trend by myself. So then if we account for the daily time frame, which is extremely bullish, you know, I don't think we could really sit and argue this is not a bullish market right now. And we layer on the fact that the Australian dollar is bolstered. They've got higher rates. So the RBA's got higher rates in the S&B. So it makes it a nice carry trade. So buyers are getting paid. And we've come down to this pretty nice support level. So I think it's quite a nice trade to really just sit through. But I'm not a big advocate for counter trading the Edge Finder. This is actually very rare. So obviously I'm counter trading the Edge Finder with gold, and I am also counter trading it with Aussie Swiss. That rarely ever happens, because, you know, most of the time when if the Edge Finder is saying bullish or bearish and I do the opposite, normally I'll end up losing that trade. So yeah, this is more a case of seeing what happens. But yeah, I wouldn't advocate for doing that. How do we watch Portugal play or FOMC? Well, let me ask you a question. Do you have a bet on the World Cup tonight? Because and also, do you have a trade open? Because if you don't have a trade open, but you've got a bet on the World Cup, maybe watch the World Cup, because that could yield some money. But if you've got trades open, watch FOMC, because the thing is, you can always catch up on FOMC the next day. You're looking at consumer sector shorts. Fair enough. I've got no idea why. Yeah, Jim Naz 100. I have to completely agree with you on that one. The Canadian dollar is definitely not in a situation where I'd want to buy it. So Aussie CAD is coming to the upside, CAD Swiss is coming to the downside, CAD Yen coming to the downside. We are just seeing Canadian dollar weakness across the board, which is actually something I've been saying. I mean, it's not a huge surprise, you know. Again, oil is coming back to the downside, which is obviously a weight on the Canadian dollar. So yeah, I mean, we were talking about the sort of Canadian dollar weakness last week, I think. The sad part is I've not done anything with that. I haven't managed to find an entry or to really do much. So it's all well and good me sat here saying we talked about it, but we didn't do anything. So it is what it is. But dollar CAD, I'd quite like to be a buyer of. So if we draw the fib from the low and we expect the high to, you know, be around here, that would obviously, you know, meet this previous resistance. I would want to see a pullback into the fib, which would be, you know, the 50% of 61.8, and then a retracement or a continuation from that point. Whether we get that, I don't know. That might be a bit optimistic, but that's the plan for now. FOMC dollar pump 99% sure bet. Yeah, okay, why not? We can be super hawkish or expect something super hawkish. Hawkish meeting expected. I think most people are expecting, I don't think, when I say hawkish, I want to be super clear. I'm not expecting that the Fed's going to come out and say, we're going to hike rates on the next meeting because of this, that, and the other. That's not really how central banks work. But I would expect them to take, you know, more of a optimistic / hawkish tilt, but again, I wouldn't expect that much. I could be wrong. You never know what's going to happen, really. But we can come to our best guesses, and that's my best guess at this time. Digital content 187 is in every YouTube stream. Oh, every YouTuber stream. That's some dedication. Still in that New Zealand CAD long, barely survived, but floating at break even. New Zealand CAD long. Let's see. I guess we were looking at taking a long, which actually would have worked out quite well if we entered on the 50% retracement. However, I would say that's a pretty decent trade. Let's just see what the Edge Finder's saying before we. Yeah, so Edge Finder's got a score of 3. Nothing overwhelming, not fantastic, but there is the slight bullish lean, I suppose. Trend is bullish on the H4. The daily is just established a bullish trend as well. Weekly's bearish, so you'd want to pay attention to this 200 weekly moving average, because every time we've come sort of close to it or to it exactly, we've seen these sort of pullbacks. So if we sort of zoom out here, and this is since 2022, by the way. I know this doesn't look like a large period of time, but again, this is what, 3-4 years of data. So 2022 rejection off the 200. Here we sort of false breakout of the 200. Didn't really come up here. Here again, dynamic resistance, false breakout, little bit of sort of resistance there, give or take. And then again, here we came up and rejected. And then previously we came up and rejected again here. So I would really be looking for the previous weekly high, which would be around here. So not a huge R&R trade, maybe. Depends exactly how you positioned it. But yeah, I think realistically that might be all you get. Again, you know, could be wrong, but from what I'm seeing, that's kind of where we're going to. Gold, please. We've actually just done gold. We did gold and silver pretty much simultaneously. But yeah, I'm buying gold, which I can talk about again very briefly in a minute. But I am off in 5 minutes. BOJ had such a nice opportunity to do a surprise hike, but they felt the need to inform 2 weeks prior. Yeah, I mean, that would have been good for my dollar yen short, which is really not doing too much, which is a bit frustrating, but it is what it is. If Walsh indicates he's hawkish, is his job cooked? No. The thing is, I assume you're talking about the Trump thing, and, you know, Trump wanting lower rates. I think even if Trump does want lower rates, I need to be very careful about how I word this. He wouldn't jeopardize the economy to achieve that target. So, you know, if the labor market's running quite well, or at least resilient, we've got sticky inflation, sure, growth has had a little bit of a turn to the downside, but I don't think Trump could justify being annoyed about a rate, you know, not having rate cuts during this type of environment. You know, I think one of the things with Trump is he wants to have sort of a legacy of doing all of these different things. You know, what was it called? Where's that place where they took the dictator? Venezuela. Iran, whether you view it as good or not, I don't care. I'm not a political person, but I don't think you would want to leave that sort of dent in his perceived legacy by forcing rate cut, or at least heavily pushing for rate cuts when the economy just doesn't need it. Whereas Nick will be on shortly. So what I can do is show you this. Look at Alan's beautiful face on there. Not sure if he's still watching. Shout out, Alan. But yeah, if you go to the A1 Trading website, or you just search for a1trading.com/livestream schedule, you'll be able to see the lineup for the week ahead. So as you can see, I'm on right now to open the show. And then towards the end, which is when we have FOMC, we have Chris and Nick to come and actually do FOMC with you. So you'll have the two experts there to make sure you guys don't miss out on any of the nuance and context and everything you need to know about the FOMC. You clearly underestimate. Well, again, I'm not here to do any political takes. I'm here to just chat and give you some trades. Oh, sorry, not give you trades. Give you trade information. Well, yeah, we'll end that there. Are you still bullish on Euro Aussie? Yes, kind of. And it's tricky because I do quite like the idea of being a buyer, but I just can't really justify the position to myself at the minute. So I'm kind of just waiting. If we get some catalyst, if something happens to really warrant taking the position, I'll take it. However, for now, I'm actually quite happy just going short on Pound Aussie and letting that one run. Again, as I said at the start of the stream, this one's more banking on sterling weakness, not necessarily just Australian dollar strength. I think this is more of a nice relative strength one where the pound is weaker than the Australian dollar, and we've got a good carry trade dynamic here. So yeah, we'll that's kind of the position there. It's not all about Trump. No, it's not. Of course not. Nick's bearish on gold and I'm bullish. Yes. So I've got 2 minutes left. So let me cover this. So if we take a look at gold, we've discussed this previously. I think Nick made a video on it as well, actually. Let's go to asset scorecard and pull gold up. So I think at the moment, and this is, I would say, one of those, it's rare, where we've got kind of two very solid arguments, in my opinion, to be buying or selling gold. So if we take just, the typical workflow that most of us, I assume, follow, which is, the edge finder, and then we go and do our typical technical analysis. Yes, gold is bearish, and theoretically you should be selling, because if we look, gold's got -7 reading, it's bearish. We've got technicals bearish, COT neutral, but the previous change, so last week, was bearish. Economic growth bearish, inflation's bearish, and jobs market's bearish. How can you really argue that? Well, the stance I'm taking with gold is yields. So yields are coming down. We've got what seems to be a peace deal coming on Friday. The signing in, where is it? Switzerland, Geneva. And we're seeing a little bit of dollar weakness, not a massive amount. However, again, another important thing here, I'm not going full risk on gold. I don't have much money on the line here. What I do have actually is more bets on dollar strength, which would obviously be negative typically for gold. So gold is just a little bit of a position, placing a little bit of a bet, basing yields are going to continue lower. And then eventually central banks can go back to, or maybe not completely go back, but cool off a little bit on the hawkish stances, which again is a nice positive for gold. So my position compared to Nick's, Nick is trading the system. It's what we really should be doing, which is, we see the data, we take the trade when it's valid. But I'm taking more of a longer term view and a bit more of a, I guess longer term is the way to take it, or the way to say it. We've got to get used to how Wash communicates. Yes, that's true. Anyway, ladies and gentlemen, we have, I've lost the calendar. It's disappeared somewhere. Right here, we have got, who is it, Tiger? Yes, we've got Tiger coming to take over the show, ladies and gentlemen. So enjoy the rest of your day. Stay safe. Don't get margin called by FOMC. I'll see you all later. Thank you for being here, and I'll see you all very soon.
This next segment of the live stream is proudly sponsored by the one and only Ola Prime. Ola Prime is easily one of the most impressive prop firms that I've come across, with an incredibly professional team. They offer fast payouts within 1 hour, up to 95% profit splits. They have the largest number of trading platforms. I mean, just take a look at this list. They have MetaTrader 4, MetaTrader 5, TradeLocker, DXTrade, MatchTrader, and CTrader all available to their traders. And that's just for the Forex side. On the futures side, they have DX Futures currently, with Tradeovate and NinjaTrader coming soon. Ola Prime has one of the widest selections for challenges and funded accounts that I've come across, with a wide range of account balances you can choose from, like 5 all the way to 200K. And just take a look at the variety of different challenges you can choose from to fit your trading style. They have a 1-step or 2-step pro accounts. They have the 1-step prime, 2-step prime, direct accounts, Ola Prime, 1 challenge. I mean, you have a wide selection here. And the reason this is so important is that you as a trader have a unique style. Everyone does. And finding the right challenge to meet your criteria is very important. If you go through their website, which I encourage you to do so using the link dropped in the live stream chat right now, you can explore in full transparency all of the different account types, all of the rules, etc. They also offer news trading and weekend holding, and they have direct and challenge accounts available. For a limited time, stream viewers get extra discounts using the promo code that you see on your screen right now, and also through the link and promo code being shared in the live stream chat. Take your trading to the next level with Ola Prime. Now back to the live stream.
What's going on, everybody? Tiger here. Happy hump day to you all. Happy Fed Day. Happy Kevin Warsh Day. We got a lot going on today. Lionel Messi had a hat trick last night here in Kansas City with Argentina, about a half a mile from where I live, actually. So I think Kansas City is his new favorite place. What do you think? But anyway, yeah, as far as Kevin Warsh is concerned, guys, James was kind of talking about him a little bit there at the end. I did a little digging on him. Keep in mind, he's not as big on the dual mandate like Jay Powell. So, you know, for him, he's a little bit more critical, Kevin Warsh is, on the traditional, the core CPI, the core PCE reports. And it sounds like he actually prefers the Dallas and the Cleveland trimmed mean PCE. So it's just a little bit different, kind of strips out some of the outliers. But yeah, that's just something we'll have to get used to. I don't think PCE is going the way of the dodo bird by any means, but sounds like we might be having some more stuff on the calendar. We shall see. But anyway, yeah, I thought that was interesting to note. And yeah, other than that, we just sit back, get our bag of popcorn and watch the show when he starts flapping his lips. Of course, you got Chris and Nick coming on during that. So definitely stay tuned to the very end. They are incredible about breaking that stuff down. And yeah, it's good stuff. So anyway, let me know in the chat if you guys have any specific tickers you'd like me to look at. As always, Nick does have his A1 live code there for the 35% off for Ola Prime. So definitely go there, olaprime.com, create you an account, and then just utilize that second row like we mentioned the other day for the code if you guys are looking to take advantage of the code for the account of your choice. So with that, just kind of taking a look at the current strength of the index or of the currencies when it comes to just the fundamentals. Of course, we still have Japan, US dollar at the very top, Aussie at the very bottom. So those three spots have pretty well been the same. When you factor in everything else, including the sentiment, technicals, things of that nature, got the Swissy and the dollar still at the top. Dollar's fallen a little bit, guys. Remember, that thing was up at the, +8, +9 range of late. So it's kind of shifting a little bit. And on the other side of that, the Aussie dollar still obviously in the hole with the Canadian dollar. And that's just kind of the way the currencies look as it stands right now. So nothing really super strong, anything really super weak. Everything's just kind of there, just kind of neutral as we speak. So pretty well neutral if you're looking at the individual currencies. So having a look at the top setups, of course, we have gained a few things. It looks like since yesterday, dollar yen's up there. Pound Swiss, which one of you asked me about yesterday, is on the list now as a bearish item. When I was looking at that yesterday, I was just looking at it from the way the trend was looking. If we take a look at that, Pound Swiss, I do believe that was the one you guys asked me about. One of you did. And I had mentioned that we had kind of bounced in this weak 4-hour supply zone from back here. If I take a look at the 4-hour time frame, and it's starting to get that kind of rollover effect. But the moving averages themselves was the reason I was only interested in looking at this thing from a long point of view, because I told you guys about this demand zone confluence down here. But yeah, the reality is, if you look at the 4-hour chart over here, it's starting to roll over nicely. Series of lower lows, lower highs after bouncing into that weaker supply. So that could potentially be the catalyst to, continue to push it back to the downside. So I don't really like the moving average look, though. That's the only downfall, but it's bounced into a supply zone, and that trumps the moving averages every day for me, guys. No pun intended on that. But yeah, if we continue to get a little bit lower, a little bit, deeper of a series, lower lows, lower highs, possibly could look for a short on this. I mean, the immediate supply zone that my eyes get drawn to is this one right here. So that's a possibility. I'll keep my eyes on it. I just think there's some other items I'd rather take a look at that just have overall better setups, because at the end of the day, I'm still kind of, in a way, fighting this uptrend, this strong uptrend, okay, according to the moving averages, which also broke the structure over here. So keep that in mind. But will that weak 4-hour supply zone be enough to push price back down to the next higher time frame demand zone? We shall see. But yeah, I could possibly see a little bit of a short right there in that 106.60 area, assuming I don't have any other alerts nearby. Maybe a smaller position. I don't think I'd be putting a fuller position size on that, because it's not really like the strongest of moves, and the volume is kind of weak, the volume spread analysis. So anyway, just taking a look at the list over here. What do you think about gold? Says Quiet Record, and D Money and Jay. Everybody wants gold. All right. Gold, thoughts on gold after the big up and down move. Yeah. So obviously gold and silver are, is it -7? Oh, it is -7. Okay. So yeah, -7 on both of those. So let's go have a look at gold and silver. We might as well knock them both out at the same time from a supply and demand point of view. So the supply zones are still in the same spot. This is a daily and a 4-hour confluence. So this is my favorite of favorites as far as confluences, the daily and the 4-hour. The only red flag or slight knock I would give gold with this area is the fact that the 4-hour gap is pretty dang weak. I mean, we got to zoom in and look at it from this point of view. That's about as small of a gap as it gets. And you guys just saw I had to zoom in just to be able to do this. So that's your inefficiency in the market right there. It's not like a trade idea killer. It's just, you guys know, I've said this many times. I like to have bigger gaps. I like to see that supply heavily exceeded demand so much that it just completely blitzed through a bigger size area than that. But it's not it's not off the limits because of that by any means. So I definitely remain, there goes my phone ringing every single time I'm on live with you guys. I get a lot of spam calls, but I'm so glad for the spammers these days, because it actually says potential spam on the phone. So thank you for that. That's just an easy FU button mash, right? So anyway, back to gold over here. So yeah, still interested in this area. I've got my alert set there at the 44.28. As always, guys, not financial advice. That's just where I'm looking. So definitely do your own due diligence. Don't ever get into a trade just because one of us say we like that area. Make sure that that lines up with whatever your strategy is. That's the important thing. Okay. We're not here to give fish. We're here to teach you how to fish. So just try as hard as you can to figure out a good strategy. Take a little bit from me, take a little bit from, the other guys on the team, and just kind of figure out a way to create your own personal algorithm. That's kind of the way it works around here. But anyway, yeah, I like it. There's really not a whole lot that needs to be said. We're currently kind of fighting this consolidation area here, kind of a smaller time frame, a little bit of fair market value for about a day and a half, 2 days. So that's currently what we're chewing into. And this is what I mean when I say I don't like trading zones from these consolidation points, because inevitably, when you revisit those areas, oftentimes this is what happens. You get those black holes. I call it black holes. You get sucked into that price point right there, and you'll stay there for several days or whatever the case is, depending on the time frame you're looking at. So that's why I don't like to trade these zones. I like to go above those. Okay. This is kind of that master pattern consolidation point. And then from here is typically where you get those expansion legs to where you're starting to test liquidity. So ultimately, now that we're in this area, I'd love to see something like this: sweep liquidity down here. Okay. And then go back up and sweep the liquidity that we've now added up here for these shorts that push down, bounce into the unfilled order potential itself, and then that's where I would be short. Okay, that's my all-time favorite setup. I don't like in other words, with this price going down like this, I don't like price just slamming up into a zone. Okay, there's not really a whole lot of liquidity there. Now, there's obviously the unfilled orders, but this right here is what creates the liquidity sweeps, to where the banks can kind of manipulate liquidity, push it around to where they can, in this case, distribute and kind of add in all those positions so that they don't have to go up here and place one giant position. Because if they do that, inevitably it's going to probably gap down before they can get a good fill. So this is kind of the way I see it as far as how they kind of layer in their orders, so that when they do get the final ping from the zone, then they can finish off their order or put in a bigger order. And then by then they've already got positions up in this area. So they can just put that final one in, push price down. So that's the look on gold. Easy take profit would be this demand zone down here at the bottom for a 4-hour time frame. So that presents quite a nice little trade, I think. I mean, let's look at the reward risk. Okay, if we put a stop loss on the other side of the excuse me. If we put a stop loss on the other side of the daily supply, keep it conservative. I mean, that's 110 points. What's excuse me, 110 times 3 would be 330. So that's close enough. That's almost a 3-to-1 reward risk if we include the daily as far as your stop loss. Now, that's the conservative way to do it, I think. Again, we don't want to be too greedy on this. We want to get into a decent opportunity for a trade. But if you're ultra aggressive, then you can put your stop loss on the other side of the 4-hour supply. I used to do that a lot, guys, where I would focus on my stop losses on the other side of the 1-hour zone or the 4-hour zone. And inevitably, what happened to me a lot was price would gap through that stop loss, stay within the daily, or maybe peak through a little bit, and then fall. So price was constantly going where I thought it was going to go to begin with. I just never was making money. So when I started giving myself a little bit more of a breathing room, a little more leeway, wiggle room, well, that's when the consistency started getting a lot better for me personally. So what else we got here? Yo, Tiger, do you know the concept of reflexivity? And yes, what do you think about it? Reflexivity. I do not. You've given me something to study. Reflexivity. Yeah, we'll see what that is. I've heard the word, but I don't know. I just stick with basic supply and demand, guys. At the end of the day, all I really have to have is just a naked chart. That's all I need. You know, all the moving averages, the volume, the RSI, those are nice to haves, but they're just nothing more than a way to support the naked chart, the candles. The candlesticks is really the only indicator we really need when you understand how to read it. But yeah, reflexivity and all that other stuff, I don't know. George Soros coined. Okay. Changed market prices, fun of those change. And yeah, that looks like a big if-then situation. I don't know. Risk on moves. Yeah, I don't know. I've read one of George Soros's books, The Alchemy of Finance. He gets a little in there, doesn't he? If you guys have read any of George Soros material, but he obviously made the $1 billion with the Deutschmarks back in the 80s. So like one big giant trade, and he was the god of trading just from that one big trade. So really smart guy. But yeah, he's just a little too alchemy for me, ironically, after reading the book. So I don't know. I just try to keep it simple. I just look at a naked chart. Yeah, I use a few indicators to kind of support the work. But they're just nothing more than odds enhancers. Give me a chart. That's all I need. That's all I want. You start getting all kinds of indicators. Guys, you should have seen my charts back in the day. I had the commodity channel index down here. I had oh my gosh, so many other things down here. And it looked like a Christmas tree. And then finally one day I got to the point, I'm like, you know what? That's just doing nothing but confusing me. It's paralysis analysis. You know, we mentioned getting your 10,000 hours of chart time out of the way as soon as possible. And once you do that, you get to the point to where you don't need it, because you can pretty much already see where those moving averages are going to go, or the indicators. In honesty, I don't really use them a lot when I'm just doing my own personal trading. I just like to do, show the visuals for you guys just to kind of get those, the visual understanding of it. But yeah, most of the time I'll just use a naked chart just by myself. But anyway, that's gold for you. So yeah, again, the alert for me, I've got it 44.28. Again, do your own diligence on this if you're looking to take some trades like that. But yeah, that's what I really like. I really like that. Really like the confluence. That's the biggest thing about this. Moving over to silver, it's got a similar zone structure. Okay, it's got a daily here, but when it comes to the 4 hour and lower, it's not as pretty of a picture over here. So just for the sake of finding a 4 hour candle with decent volume, it's this one here, and it kind of cuts in halfway in and halfway out of the daily zone. So, you know, from there, what do? Well, you just go down to smaller time frames. Inside of that 4 hour, we kind of had this 2 hour. If I get rid of the drawings for a second. So kind of the bottom side of these, the bodies, the opens and closes down here at the bottom, the real bodies. That's kind of where I drew this, this line here to kind of utilize as a possible entry short. But honestly, if gold and silver get up there at the same time, I'm taking gold. I'm just taking gold because I just think the picture looks a lot prettier over here. Even a 2 hour on gold, you can see that's just an easy zone right there. And I don't say easy as in trading's easy. I just mean it's easy to spot. Okay. 1 hour. There you go. I mean, there's your proximal line on a 1 hour basis right there. So if I wanted to save a little bit more and increase the reward risk a little more, well, then I would probably rather wait for that price. But hey, it's already hit a daily and a 4 hour. Those are two strong zones. So if I wait on that 1 hour or that 2 hour, may not get that fill. It may just hit the proximal lines of these zones and just take off to the downside. So I personally would probably just go ahead and take it off the 4 hour. That's why I have my alert there to begin with. But, you know, depending on how reward risks are, if this did not provide me a decent 3 to 1, if it was only like a 1.5 to 1, 2 to 1, okay, at that point I would probably wait for the higher zone because that'll shrink my risk, or that'll shrink the range a little bit and increase my reward. So, but for this one, we just measured it. It was right at about a 2.7, 2.8 to 1, just by using the proximal lines down here of the higher time frames. I'm gonna stick with that. Okay, so that was gold and silver. What else we got? Taking a look over here. I was watching the Swiss yen, dollar yen. Guys, dollar yen I still think is still too crowded in that overhead supply. We'll take a look at it here in a second anyway. Swiss yen. Okay, Swiss yen longs. So the moving averages just doesn't look like a pretty picture over here. It's pretty well in the center of all this. That's almost like a diddle in the middle area, kind of the middle of the curve. And I don't really like it from that perspective. Okay, again, this is typically where the retail traders go and lose a lot of money. So I want the extremes. Yes, it is on my list. And yes, I do think I put an alert down here. But this would only be if I were to get into this trade right here, there's only really one or two ways I would do it. Number one, I wouldn't just buy the top. I would wait for the 1 hour confluence. And if it touches this overhead supply first, then this is a no-go. Okay. But so far, it hasn't touched the overhead supply. So I like it. So I would probably just look to take this just for a few pips, guys. I mean, if I get my projection tool on over here, just drop in. Again, we're collecting 4 hour eyeballs and we're collecting 1 hour eyeballs liquidity, unfilled orders. And then I would just sell out before this overhead supply. I don't want any part of that, especially buying from a 1 hour time frame. Okay. So that's another area I'm looking at, the 201.68 area for the Swiss yen, since that's one of the newest items on the bullish list over here. Dollar yen, that was one of the other ones that I was looking at. And this thing is still just trying to chew through the rest of this daily supply up here, guys. I kind of drew up a 4 hour zone over here on the left. Let's refresh this. Okay. And that's currently kind of where we're getting a little bit of issue, as you can see right there. This is one I drew up yesterday. While also keeping in the context that we're still kind of chewing through. Let me just do this. We're still trying to chew through this 4 hour zone from the top of the daily. Okay. So this is so basically we're in two supply zones. We're in three supply zones. Okay. Daily, the old 4 hour confluence, and then this newest one. And that's currently kind of where we're getting a little bit of trouble. So, just like I mentioned yesterday, I'm not really interested in trading dollar yen unless we can kind of break out above we break out above all this nonsense, I don't know why I have an alert up there. Just delete that. Break all this structure to the top, get a close, and then if we can retrace into a decent looking zone. But again, all these candles, they've all been too small for my taste. There's no real expanded range candles. In other words, a candle that's like 3x, 4x bigger than the previous candles. Okay, there's just no strong candles here outside of this strong downwards candle, which again is partially because of the overhead supply zones that it's bouncing into. So yes, it's bullish, but I don't have a play. I don't have a play at all. And the last play we had was when we touched this demand down here, guys, this daily demand that shot up. So yeah, I don't like it. I don't like it at all. I got to admit, we got to break all that upward structure first. Dow, NASI, taking a look at those. Yeah, not a whole lot's changed. We still have yet to break this structure. And I told you guys yesterday, I would still buy from this zone of demand down here. If it doesn't break and close, I'll just have to decrease my risk. I'm not going to put a full risk on a zone that didn't break a major structure like this. I mean, even when it came up to this minor structure, it had a little bit of issues because it took about a day just to chew through that. So does that look very strong? Again, if it's a strong zone, it should produce enough momentum to just chew through all that. And it didn't do that. It had some troubles here, and currently it's still not breaking this, still not breaking that. So this would just be a partial position for me for NASI. Say for Dow, this is a full position. This is the difference because this zone here pushed prices through and broke all these structures. So you guys see the difference there? To me, that's a huge difference because, again, it takes a lot of money to break a structure. Dollar Swiss, says Antonio. Yeah, let's have a look at that sucker. Dollar Swiss, I know it was on our list for a while. I haven't seen it lately, so it looks like it's pretty well neutral. Pretty close to Dollar Swiss. Yeah, -4. Okay, so really good bearish picture from the sentiment analysis side of things. Pretty good on the fundamentals too, but it looks like the trend is the hiccup. So let's have a look and see what's up with the trend on this thing. It's acting like the trend is up a little bit. So let's go find Dollar Swiss. Okay, so yeah, overall, the trend is up. But the thing is, it bounced into a higher time frame supply. So that enough could be a catalyst to push down. But the problem is you got this daily 4-hour confluence just about to touch. It's already messing with the daily. Go a little deeper. Now you get that second set of eyeballs and you get a bounce off the 200 EMA. I don't want to be shorting into that. So it's kind of a similar thing to the dollar yen breaking the top structure and kind of regrouping from there. Same thing would have to be true down here. I'd have to have a break of this demand zone and then maybe a retrace up to a new supply zone. So that's another no-go for me. In fact, I'm going to delete this. I don't need that because that was old news from back when I was looking at some bullish looks. But yeah, this is just kind of the hiccup for me on Dollar Swiss. But yeah, if we break it, okay, if I take a break and get a close down here somewhere, get a retrace, if we can get a newly created supply zone, then that would open this up. But where it stands right now, just not interested. I mean, if this candle can close, if the candle right after can just give us a big, ugly red candle, big, strong momentum candle to the downside, expanded range candle to the downside, then that would show me that we would have some strength in here. And this would almost be a flip zone off the daily zone. So those are pretty strong, guys. Remember, when you have a demand zone, as an example, and then you have price chew through that demand zone, a lot of times you'll get a newly created supply zone somewhere in this area. Okay. When you get those flips, they can be pretty strong. There's about 8 different supply and demand zone looks, and that's one of them. So it's not one I've really talked about a whole lot with you guys, but that might be something I'll do. I'll come up. There's a list of 8 of them. Okay. I'll come up with the list of them. Would you guys like to see a list of the 8 different ways of looking at supply and demand zones? If so, yeah, I've already got a list. I can go find that and put it in like a quick 1-page visual for you guys. I think I'll do that. Yeah. Hold me to that. I'll try to get that out either tomorrow or Friday. But anyway, that's the look on Dollar Swiss. Sorry, I couldn't be of help to you, but with my strategy, it's just there's too much liquidity in the way of trying to short it. Okay. Yeah, absolutely. Jesus, I'll get that. Let's see what time. I got 4 minutes. And I know we got Alan coming on right after me. Again, stay tuned for Chris and Nick later, guys. They are, especially if you're newer on here, they are very, very good talking macro and obviously the rates, decisions, and outlooks, Kevin Walsh, and all that. So definitely stay tuned for that. Let's just do this. Since I've just got a few minutes left, I'm just going to go take a look at some of the alerts I've already got set over here. And I just added a couple more. Let's see, New Zealand CAD. I think that was an old one there. Pound dollar. You guys remember I was watching this 2-hour supply zone over here, and it wicked in, but I also had my second set of eyeballs a little higher. Okay, this was the 1 hour, 30-minute area up here. It just barely missed it. And that's from there, that's kind of where we're starting to get just a brand new series, small series of lower lows and lower highs. So could the 2-hour zone have been enough for this move to be made? I still think there's a chance we could get a retrace because it's not like we had a very strong drop. Like throughout this price action, yeah, this was looking like that zone could have been strong. But then we retraced. We got lazy for about a day before rolling back over. It's not like price from here. It's not like price from here just continued down like this. Okay. It had this retracement hiccup. Now prices ebb and flow all the time. But again, if it was a strong bounce from this zone, it would have just dropped. Bottom would have fallen out, but it didn't. So I still think there's a chance we could come back up, jump into that smaller time frame for a short. If so, that would be excellent because we've got all kinds of liquidity here, guys. Right here where the shorts push price down, they put their stop losses in this area, right? Same thing here. The bears push price down. They are leaving their stop losses up here. So I still think there's some liquidity up in this general area to where if we come up to the 1 hour zone, the 1 hour, 30-minute area, then that's going to be my favorite spot to short. Pound dollar is still giving us a -6. But let's finish on CAD Swiss since that's the weakest currency. And CAD Swiss. I don't even think I have an alert set. Yeah, I don't have an alert set on that one because, again, I just didn't really care for, well, number one, we bounced into the daily demand underneath, guys. That's really kind of the red flag right away. Okay. So a lot of these are kind of a similar picture. If I'm trying to short, there's a demand zone too close. If I'm trying to buy, it's either in a supply zone or it's too close to one. So I just need to see some breaks of some of these zones and then get some retracements, maybe some flip zones created before really getting in. Because honestly, the move to be made has already happened. We had the daily supply here. And then inside, we had that zone on top of a zone that I talked to you guys about a couple weeks ago. It chewed through the first zone. And it was the second zone closest to the origin of the overall strong move down, which, of course, is our impulse leg, right? That bearish impulse leg. So, again, price tends, I'll end it on this. Price tends, when we see an impulse leg that has broken a structure point like this one did back here in the past, okay, we broke structure. When you get that bullish or bearish impulse leg, I'm trying to find the zone as close to the origin as possible because in this example, you've got a couple zones that have gaps showing that inefficiency. Banks a lot of times will attack the closest inefficiency, meaning the gap before the zone, so they can get the absolute best price. In this case, the highest premium. Okay, in reverse, it's the cheapest. It's just like we buy or sell anything in life, guys. Buy low, sell high. So that's why, and it makes total sense why this supply zone is the one that grabbed and we got the big push down because it was the first inefficiency at the start of that bearish impulse leg. So, ladies and gents, with that, I'm out of here for the day. Hope you stay safe today. Okay, this is the popcorn trade of the day. Get your bag of popcorn. When he starts flapping his lips, hello, pink tie, whatever it is, just sit back, put your favorite chart on a 1-minute time frame, and watch this show. Alan's up next. I'll see you guys tomorrow.
If you're enjoying the stream right now and would like to join us beyond just live streams, consider joining our free-to-join Telegram channel. Inside of our Telegram channel, we're sharing daily market analysis, bonus clips from the live streams and videos, giveaways to our products, prop firms, and brokerages, and much, much more. So like I said, if you're looking to stay up to date with ideas that we're looking at in markets, even if you can't make it to a live stream, consider joining our Telegram channel down below in the description of this live stream, or being dropped in the live stream chat as we speak. Just click that link, it'll navigate you over to Telegram, click join, and you can come back to the stream. It's totally free to join, and if it's easier for you, you can also just use the QR code that you see on the screen right now. Now back to the live stream.
Good morning, good evening, good afternoon, everyone, wherever you guys are watching. Happy Fed Day. Very, very excited for this one. This is a very important Fed day. I would say the most important in all of 2026 because we have a new guy coming in. We have war. So I'm very curious to see how we are going to look like. Like the ad said, go ahead and join that Telegram channel. It is completely free value to you. Every single day we put chart markups, bonus content, polls, all that good stuff, discount for prop firms, everything like that. So definitely go ahead and to join into that. And I would also add as well to join the free Discord. Again, if you want to chat with other traders, very good community that we have going on there. So go ahead and join that. And with that, let's get right to it. So very, very big, important day today. I actually took off my dollar Swiss position that I had on just because it was right by break even there. So I wanted to solidify that profit and trade after with some more clarity, right? After the Fed meeting, if we have, a hawkish hold or a dovish hold, I definitely want to, trade after that and then just ride the move after that. So dollar Swiss there was a break even trade for me. So I got out right here and we'll see. If you get a hawkish Fed, right? If you get a hawkish Fed, I am shorting euro dollar. That is a trade that I've been riding with for some time now. So I'm going to continue that momentum there. If you get a dovish Fed, then I'm going to go ahead and short dollar Swiss. So dollar Swiss right here is at that 200-day moving average. So something that it needs to overcome if you are going to see some follow through to the downside. So I'm going to be watching that level closely there. I still have my gold long position though. So this one is still in profit. You can see here up $930 on the prop account. Also as well, you do have this level of support here and that 200-day moving average that you need to overcome. The reason for this trade is this was more of a proactive approach to the potential of a dovish hold. I'm actually in the camp of a dovish hold. Now, I know a lot of the stream viewers here are not. They're actually still long dollar, which I am too in the long term. However, I do think that you do have, Warsh here. He was, chosen by the president for certain reasons. And I think that maybe he'd give some kind of a dovish stance, or if not a dovish stance, but even just like, we're going to hold rates steady. I think the market would take that as quite dovish as well. And so that's why I was being proactive and going gold long. Also too, right, you can see that the price of oil has been going down lower right below this level here. This was basically support during the whole war. We are now breaking right below that as well. You have yields as well. The US 10-year yield is now breaking above that upward, or breaking below that upward trend line there. You can see that above here. I kind of have it marked up as you can expect some restrictive policy if you are above that 4.5 level, and below you can see some more loosened policy. So with that in mind, I think that the Fed could be willing to go ahead and cut rates if you do get a solidified war to the end. And speaking of the war there too, I know it's been back and forth, but it seems like this time around it's looking a little bit different there. You have some agreements from both the US and Iran side, which is good. And I saw a headline here this morning here that, where was it? Maybe I need to refresh the page here. But essentially that they're willing to move the signing for the agreement up to today. So basically, there's a potential that you may get a solidified deal signed for today in the war in the Middle East. And if that's the case, I would say I could see some follow through in dollar to the downside, yields lower, oil lower, and that'll help the gold trade. So we'll go ahead and see. So I have that going for me as far as this gold trade. However, the Fed is going to be the big important one. We have the dot plot, right? We have forward looking projections as to what's going to be going on with rates. So yeah, if you do get a hawkish Fed, again, going long, hawkish Fed, short euro dollar, dovish Fed, short dollar Swiss. So that's kind of my game plan there. And by the way, guys, I'm sorry if I sound slightly off. I woke up with a sore throat there, so that's been developing. But if there's any chart markups, anything that you guys want me to go over, feel free to drop those into the chat, and I will go ahead and do my very best to go ahead and cover those markets with you guys. Something that happened yesterday too, a little bit of a rotation out of tech. So it's kind of rebounding now. Nasdaq's up here about 0.5%, but yesterday you saw a sell-off there in the Nasdaq. I think it finished down 1% plus, and you had a rotation going into like the Russell, which was interesting. So I think you're seeing, the broader rotation story is still alive when it comes to tech and AI, and I think that it's going into the broader market. So I see that's good, right? I was talking with Marco yesterday, but I think this was the dip for now, I would say. Considering you have the SpaceX IPO, you have a lot of euphoria, you have a lot of other big names as well coming into the picture, like Anthropic, OpenAI. These are really big names, very sexy names that are, very enticing to investors. So I think that for now, this was probably a dip. And unless you get something material that changes, like for example, revenue missing expectations, things like that, or a higher yield environment that could be confirmed by today's Fed meeting, definitely I think that can disrupt this. But for now, I think that this was a dip. And for the most part, Nasdaq can probably continue trading higher. So we'll go ahead and see how that unfolds. Let's go ahead and talk about dollar yen as well. Dollar yen, a little bit softer here, or at that 160 mark. This is very interesting. I think that you have the potential for dollar yen to start falling if you start to get that dovish Fed mark. I think, the 160 handle where we're at right now is very dangerous territory, especially since the MOF is looking to go ahead and intervene right here as well. So I think that if you get, some kind of a dovish Fed, just the thought of possible intervention at 160 for dollar yen could cause this thing to go ahead and go lower. So I'm looking at buying the dip for dollar yen about 158, 156-ish area. I think that's great value for dollar yen to go ahead and continue, trading this thing to the upside. Because ultimately, fundamentals, you do have a pretty wide rate differential between that. That's pulling this thing to the upside, the famous carry trade, as we all say. So kind of what I'm looking at for dollar yen. Dollar Swiss, I think, would be a big dropper if you do get a dovish Fed. So I'm going to continue going short if that is confirmed. But if not, I will say that this 200-day moving average just acts as support. That's what I would say. Forecast for gold, I just said it, man. So forecast with gold, I'm currently long in it. If you were to get a dovish Fed, then I think this thing continues to go up, especially if you overcome that 200-day moving average and this level of support. So if you get a strong close above this, then I think gold can continue to the upside, maybe targeting 5,000, 5,200, somewhere around that. If you get a hawkish Fed, then most likely you'll see yields shoot higher, right? So you'll see this chart move higher there. If you get yields higher, then that's going to pressure gold. This would be just a very clean technical break, retest, and a continuation to the downside. In that case, I'll get stopped out depending on what I'm doing. But if you get like a hawkish Fed, I'll probably just manually close this trade out. But that's basically where it's at right now. So you are basically in the middle of a very important zone. It can go either way. Which I know that's not the answer you're probably looking for. I wish I had a crystal ball, but I don't. So that's kind of that. Looking at Euro USD on the daily, beautiful short. Technically, it would be nice to see a hawkish Fed. I agree with you, Jesus. So if you do get that hawkish Fed, I've been writing that way for a while. I'll just go and hop right back into euro dollar short. And if I look at the Edge Finder too, which is the tool that I use to kind of help me out with my fundamentals and sentiment and just pulling everything all together to give me one great, good trade thesis, considering all things. Euro dollar right here, if I look at it, it should be bearish if I'm not mistaken. Euro dollar still getting a bearish reading of -5. So that plus a hawkish Fed will give me all the confidence in the world to go ahead and short euro dollar. And what that would look like too. So let me go ahead and just go to a 4-hour time frame here just to show you essentially what my targets and everything will look like. So shorting, let's say hypothetically we get filled at market right here. Let's see, I would put my stop. This seems like a good level here. About 58 pips above, and then my take profit would be first at 1.15, and if you surpass 1.15, then I would go all the way down to 1.145. So at the moment off the get-go, you would probably get a 1-to-1 risk to reward, which is not the best, which is okay, but it does have the potential to go ahead and extend to a 2-to-1 if you break this level at 1.15. So we'll go ahead and see how that plays out. If I go long euro dollar, different story. I probably wouldn't go long euro dollar, so I'm going to take that off. I would go long dollar Swiss, right? If I want to go dovish Fed, bullish dollar, then I would go long dollar Swiss or short dollar Swiss. I'm sorry. So what that would look like here, basically like this, and put my stop right above this high right here, about 100 pip stop loss. And then I would shoot for something like down here, which is 0.778, right? So that's it's 1 to 4, which is not the very best, but, or 1 to 1.4, I'm sorry, but not the very best, but again, good probability trade if you do get a dovish Fed. When you talk about relative weakness and strength, you can see that dollar Swiss here has been trading lower, whereas dollar yen has been trading upward, and dollar CAD has also been trading upward as well. So I think dollar Swiss on a relative weakness basis, if you do get that dovish Fed, I think this one is really well positioned to go, continue to the downside and overcome that 200-day moving average. So that's kind of what I would look like. And then as far as from trade management standpoint too, I might as well cover that as well. So I would put my stop above here, right? That 100 pip stop loss, and right here. And then I would mark this level up right here where this 200-day moving average is. This to me right now, as the time of speaking this, looks like a good level of support, right? So if you were to break below this, then as price action, if it does continue to the downside, then I would just go ahead and trail my stops right above this structure here, and so on, and protect some of my profit. So that's how I would play dollar Swiss. In fact, I'm actually going to keep this level here because I really like how it looks. So this was, resistance here at one point. We broke out above. We are now retesting into this level right where that 200-day moving average lives. And so we'll go ahead and see. So this is a very important pivot point, in my opinion. It can go up or down, but nonetheless, I'll be prepared for it and ready to trade it. Any other chart markups, though, that you guys want me to go over? Bitcoin. Yeah, let's look at Bitcoin. This was on my watch list as well. Bitcoin here, I'm waiting for a bigger pullback into this area here, this gray area. The higher the better, in my personal opinion, and I would be willing to go ahead and short this. There's a lot of things going against Bitcoin. One is the higher rate environment that we're in, right? That's just kind of hurting that. You also do have just attention going elsewhere. So Bitcoin is no longer the shiny, sexy object. It's now, your Anthropic, your Claude, your SpaceX, right? Those companies are taking all the attention. And so all of that speculative cash, I think, is just transitioning over to that side of things. So Bitcoin there looks relatively weak in my personal opinion. What is Edgefinder saying on Bitcoin? I think I saw it getting a bearish reading as well. Maybe mistaken. It's getting an ultra reading, so not positive or negative. So again, I would wait for a deeper pullback into like 72.5-ish, or even up to that 200-day moving average, ideally. And then I will go ahead and short Bitcoin. And then I would target ultimately 50K. If you kind of just zoom out here a little bit, 50K seems like a very, very strong level of support that I think a lot of people are watching as well. I think that would be very good, fair value. So shorting Bitcoin into 50K, you can see here that this was like resistance at one point, right? We broke out here, found some support here. And in the long term, this looks like a very, very good level. So 50K is kind of my target there on Bitcoin. So fingers crossed that I can get an opportunity to short it. If not, I'm not interested in chasing price whatsoever. So if it starts moving against me, so be it. Maybe in a world you get a break and retest to the downside. But again, I want to go ahead and short at a premium. I don't want to be shorting and chasing price. So that's kind of my thought process there on Bitcoin. I would also need to see the Edgefinder confirmation as well, pointing me in that direction. So that's kind of my thoughts there. And by the way, guys, this is the tool that I use to go ahead and, help me with my charts and, finding my trade ideas and using fundamentals. So definitely go ahead and, purchase the tool. I think there's a discount going on, but if not, you can just use the code ASPIRE to get 25% off. And I promise you this will help you trading in many, many, many ways. Okay, let's see. One last chart that we can look at here before Marco goes and joins me here. Let me see. Dollar CAD is annoyingly strong. This is one that I've been missing out on for a very long time. I've been wanting to get into this trade. Haven't had any possibility, any opportunity of getting in here. No pullbacks whatsoever. So again, maybe I'm kind of positioned and hoping for a dovish Fed to get some softness in the dollar so I can ultimately pick up this thing in the long term. So I like dollar CAD. The fundamentals underneath the Canadian economy is just not looking too good. So yeah, it's getting very close to that profit target there at 1.14 or 1.41, I would say, which sucks because I've been wanting to get in here since like way over here, right? And just no pullback whatsoever. So let's see. The 200-day moving average to here, that's about 240 pips that I've missed out on, which not fun. Reminds me a lot of the Australian dollar that I was wanting to, get into, but I just never got the chance. Hey, Marco.
Hello. How are you?
Good, man. Got a little bit of a sore throat, which sucks, but other than that, I'm very excited for Fed Day.
Yep, me too. Absolutely. So are you still running the same things?
I actually excuse me. I closed out of dollar Swiss
Okay.
short
Mm-hmm.
because it was right there at my break-even mark. So I wanted to basically take whatever profit I could, which was like $300 or whatever,
Okay.
and then reposition after once I get more clarity. The gold trade is a different story. This one's kind of moving in my direction there. So I have some wiggle room to actively manage it. If, for example, you get a dovish Fed, then I can just close out of this manually. But for now, I'm still, my bias is still some kind of a dovish hold, in my personal opinion. I think
Yep.
general consensus from what I've gathered from listening to the other viewers or the guest show hosts is like they're thinking of a hawkish hold. I think that with oil lower, yields trading lower, potentials, I don't know if you saw this, Marco, but the signing for the deal could be pushed up to today for the deal in the Middle East. So
Yep.
I think a lot of positive catalysts that are hinting at, a peace, which is soft for the dollar, good for equities, risk on, right? So I'm going to kind of stick with that until proven otherwise. And the Fed, the 4 projections that we'll see today will definitely go ahead and give me some more clarity as to like which way we're going.
Yeah. I'm definitely gonna be watching the press conference. It's starting. So first we get the interest rate decision, and then half an hour later we do get the press conference. But in my opinion, the most important part will be the dot plot. So I don't know, like people are trying to forecast. Is Kevin gonna be hawkish? Is he gonna be neutral? Is he gonna be dovish? No one knows. The only one that knows is Kevin and anyone that's read his speech, basically. So what we can prepare for is the dot plot. And I think that the Fed members, I know Trump wants to cut rates. I know Trump wants them to be super dovish. But I think the Fed members, most of them are staying independent, and that they're seeing the data, they're seeing the hot prints in inflation. I mean, CPI above 4%, PPI above 6%. It's no joke. Those are pretty high numbers. It's not like after COVID, after the stimulus, after the huge money expansion, it's not like that kind of inflation, but it's still way above target. So, and I know there's a very high chance of a deal, but I don't think that the Fed can calculate the deal in their projections. Of course, they could say like this inflation is transitory. And then the question is, well, how much of the inflation is actually from the oil prices and how much is it from something else?
Exactly.
So that's another question, which I haven't done the research on that. Probably should have, but I'm not sure exactly which sort of baskets are influencing the high inflation, and it is pretty high. So I think the dot plot goes higher, the rate cut that we're supposed to get is pretty much going to be off the table. And then you have the question, do they hike by the end of this year, or do they just stay neutral? To be honest, I think the dot plot stays neutral with no hikes or cuts this year. And Warsh comes out and says, we need more data. We need to see what happens in the Middle East. We need to see what happens with the CPI and the PPI in the next coming months. We're gonna stay flat for now. So that's how I'm seeing the situation. So not really tradable. Not really a tradable event.
I would say that, in my personal opinion, if you were to get rate holds as the future projections, like no hikes but just rate holds, I think that would be taken very optimistic by the market.
Okay,
that's just my personal opinion, but it's very tricky because if you look at Warsh's past, he was an inflation hawk, literally, which is the environment that he's inheriting right now. And then you look at today, he's obviously appointed by Trump for obvious reasons, right? So, does he revert to old ways? Does he not? What is he going to do? Is he very, does he select the inflation prints or, strategies that are convenient to his agenda or Trump's agenda, right? That's another one. So yeah, very, very tricky. I'm very curious to see how he presents himself, honestly. It's like my biggest thing, but I know Fed independence has been one thing of questioned, especially with this new Fed chair. Is he going to uphold that or not? So that's kind of what I'm looking at. So as far as trade setups, Marco, I'm kind of in the camp of, if you do get that hawkish Fed that it seems like everyone's pretty much anticipating, I'm going to continue with my euro dollar short position, right? I'm going to continue riding that wave until it gives out. If you get a dovish Fed, then I re-enter dollar Swiss short, From a relative strength perspective, you can see here that dollar yen has just been trading upwards, dollar CAD even more aggressive, and dollar Swiss has been the only one that has been actually trading downwards. So I think that if you get dovish Fed, again, that adds more fuel to this, and then I can, continue trading this to the downside. And then I have my, gold long here on the prop account, which will be contingent on whatever happens today. I'll manually close it out. If it's hawkish or if it's dovish, I just keep writing it, and hopefully we overcome that 2-day moving average. Pretty simple in my case. Also, too, one thing I would add, dollar CAD. If you get a dovish Fed, I'd be looking to buy dollar CAD on any meaningful dips, but pretty much it. So only 2 to 3 asset classes or pairs that I'm looking at. For you, is it any different? I'm curious to know like how you're going to approach this one.
So for me, and just a question, so are you looking to put on size immediately after the press conference, or is it something that you're looking to unwind in the rest of the week?
As far as if you were to get like a hawkish tone,
if you get you're looking for a dovish event, right?
Yeah, if it's dovish event, I re-enter dollar Swiss short.
Okay,
that'll be that'll play. I'll keep whatever I have running on this gold prop running. I would go dollar Swiss short with some size. If you were to get a hawkish Fed, same thing. I'd put some meaningful size on euro dollar short. I think still like if let's say price is where it's at right now, which there's gonna be lots of volatility, but you're kind of like in this middle zone here. So if I get filled somewhere within this area, I think it's still pretty good. Especially if I'm trading this to the downside, right? I still have, this first zone as profit target, and then I have this one as well, the secondary one at 1.145, which gives me about 145 pips of profit potential. So as long as we're like right here, like if I get some clarity and we're still within the zone, I can put some size. But if I get the clarity but price is all the way over here, then my size is going to be a lot less, right? Because I don't want to be filled at a bad price. I don't want to be chasing or anything like that. So that's kind of what I'm looking for. Yeah,
cool. I think that's a pretty good plan. And the main thing I'm looking at for the press conference is what is Kevin going to do. That's the most interesting aspect. So will he kiss ass to Trump? Will he do his own thing? Will he pick the most dovish sort of inflation print? It's very interesting because you're getting this kind of guy that has been in the system for years, I think even decades. He has all of the credentials, same as Powell, so he's essentially a younger Powell, but he also has a good relationship with Trump, which Powell, at least at the latest, didn't have. I think Trump picked Powell, didn't he?
Yeah, he did. And I'm laughing because they definitely don't have a good relationship now, especially with everything that happened. But Trump did appoint him.
Yeah, I know they fought even in Trump's first term. So I think Trump appointed him, and then Powell didn't cut rates as aggressively as Trump wanted, and then there were some tweets coming out. So same thing that happened recently basically happened in Trump's first term. So will Kevin be the Powell, or will he be more like what's that guy, the surname that always votes for a cut? I forgot, but there's one guy that is appointed by Trump in the Fed committee that just votes for cuts all the time, like 50 basis point cuts no matter what is happening. So that's going to be interesting. As far as my positioning goes and my game plan for the event, so if I just put up the charts here, let's put up the okay. So I am running a short on GU, which is right around break even. I'm going to leave it open into the event. Personally, I'm betting for a more hawkish event because I'm focusing on just the data and trying to ignore all of the headlines and not exactly sure what's happening in the Middle East. There's a lot of sources and not a lot of confirmations. So this is one of the positions. And if the Fed turns dovish, that's going to be great for the S&P, the Nas, and the Nikkei. So I'm going to try and go heavy in those. Not immediately because I need a pullback, but I'll wait for a correction and I'll be much happier to get in. And also, I'll keep an eye out. So I've started to track individual stocks. And if you get a dovish Fed, that's a great story for individual stocks. By the way, for any people that are interested, so I found all of these good stocks like CAT, Palo Alto, Global Foundries, Snowflake. So I found them on the stock box. I found them on the scanner. So it's here under the heat maps. And of course, every stock you can run it through the stock scorecard to get a reading. So Edge Finder, not the Edge Finder, but the stock box is a great tool for stocks. And you can use the code. What's your code, Alan? Aspire.
Marco.
It's Marco.
Use code Marco.
So you can use the code Aspire, or you can use the code Marco to get a nice discount, and then Alan and I will split the commission. That's what I'm looking to do if there's a dovish Fed. If there's a hawkish Fed, I like the dollar long story even more. So I may put on more size not on GU, but on EU maybe. But also I like long USD CAD, which has run away, so probably not USD CAD. NZD looks nice as well, so it's near the 20 MA. I think EU and NZD look good to short if we get a very hawkish decision. Would I do it immediately after the event? I don't know. Depends on if I'll be done with cooking, because I'm making tortillas today. So I'll see if I'm done in time. But I'll have the event open on the side, so I'll be listening in.
Nice, man. I'm jealous. So you mentioned, right, if you were to get a dovish Fed, then you would be bullish stocks. But we've talked about this, Marco, yesterday specifically. I personally said this was the pullback, which doesn't really look like much. In fact, my apologies. Let me put my screen up there. I said this was the pullback, which is not really a pullback. Would you be looking for something similar? I know you said that you're not going to enter right away immediately, but you are going away from some kind of a pullback.
Yep.
What kind of pullback are we talking? Are we talking something like this or something of bigger magnitude?
Something like this. So something that exactly what I've missed so far. So just to the 20 MA, I think that could be a good opportunity. Maybe not even to the 20 MA, maybe just to a level of support. So maybe a smaller correction, smaller pullback. But to be honest, mostly I'm looking to play it through individual stocks, because that's something I'm trying to work on in the next few months. So that's going to be kind of the main thing. And then if I can get into some indices, well, it's going to be good as well. But for the Nikkei, it's a sad story for me. I already missed 2 dips, and I've been getting some comments on my YouTube channel. People asking, Marco, are you in the Nikkei? Did you catch the pullback? You were looking at the 20 MA, and no, I didn't. I didn't catch it. Didn't fit the plan. So yeah, missed the boat, missed the train.
I missed the boat on dollar CAD, man, and I'm selfishly hoping for a dovish Fed. Just so you get some softness in the dollar. Ultimately, like I'm on the same boat as you as well, as far as looking at the data, right? Inflation's elevated. I think a pullback in the dollar is fine. Buying the dip would be worthwhile. So dollar CAD for me is like one of the ones that I've also just completely missed it. I've been voicing my opinion on this thing for some time now, and I just haven't seen anything similar to the Nasdaq. Like it seems like whatever this was the pullback, and then it just continued ripping higher. So unfortunate situation for me. Anything else that you're watching, Marco, here before I go ahead and pivot out and let you do your solo segment? Like Bitcoin is kind of up here today. Are you still looking to short this thing? Are you on that boat? Are you looking to short Bitcoin like me or no?
No. I think 50K is a good target to have on Bitcoin. You're getting Saylor. I think he's not selling again, but he's in major trouble, and he's the Bitcoin guy, so he holds a bunch of it. So the whole narrative is rotten, I would say, right now. The whole narrative is very bearish. The hype is not present, which is good if you're a very long-term holder. Then maybe you could get in at these levels, but I think short-term we go down even more. So if you look at the past corrections, you had 70-80% corrections, and this one is currently sitting at 50%. So a lot more downside could happen. I think 50K is the first target. 40K, 30K could absolutely happen as well. But the thing that I'm watching is SpaceX. So just out of interest, SpaceX. I think it's above 200. Haven't checked it on the open. Okay, just below 200.
224, man.
But it has been pretty interesting. A pretty interesting story. Personally, I thought it was going to sell off, but I don't have a lot of experience in monitoring IPOs. I think the Tesla IPO went up at first, and then in the later few weeks it dropped close to the fair value, maybe, not sure. But the fair value of SpaceX, if anyone is wondering, is around 97 because they're operating at a net loss. By the way, all of these guys, so all of the artificial intelligence stocks are operating mostly at a loss. OpenAI, I think the revenue is 2 times smaller than the expenses, and all of them are looking to do an IPO. Interesting. You had Cerebral, you had SpaceX, which is kind of an artificial intelligence company because they're using Grok, which is shit, if I'm being honest. Then you're getting OpenAI later this year, and Anthropic, which is Claude. And Google Gemini and Claude are my favorite ones. Not sure. What about you? Yeah, I wanted to ask you. So as far as trading goes, Google Gemini or Claude?
I love Claude, man.
Claude? Okay.
I think for your more ambitious tasks, I like Claude a lot. I'm building a risk tool, so essentially, for my prop trading and also just for my personal as well. But essentially, this thing that I have here helps me manage my risk. So it, goes over outstanding trades that I have, how much P&L or how much equity I can, put into before breaching my personal limits, because my personal limits have to be more strict than the actual prop account. That way I can pass it. So I'm basically turning this into a very neat dashboard that I'm going to be bringing out one day. But it's been helping me a ton with that stuff, right? I'm not a coder by any means, but it has helped me in that. So I like Claude for those ambitious tasks. When it comes to the creative work, like image creation and stuff like that, I like using ChatGPT has a very good image model, but also Gemini's Nano Banana is very good as well. So I kind of use both of those. I've been using Midjourney. I just bought a subscription to that one, but I actually don't like it. It's supposed to be very amped up and everything, but it's not it's not a large language model, so the prompting is very different on that. But I like Claude. If I were to rank them, Claude would be number one.
Yeah, I would agree. Day-to-day stuff and quick research, I use Gemini because I found it has more access to data. But if you need to assemble anything, especially assemble data points, Claude is the way to go. And do any type of deep analysis with numbers, I think Claude is a much better option. So yeah. I'm not going to hold you for too long, Alan. I know you have a sore throat, but thank you very much for doing the joint segment. I hope you will be present during Nick's segment during the press conference, because it could get entertaining in the chat. So I'll see you in the chat.
I'll definitely be around, and I'll be here in the background if anything. Guys, go ahead if you guys can do me a favor, join the Telegram channel and the Discord. But I would ask that you guys leave a like on the live stream if you can. If you could just take a few seconds to do so, that'll bump us up on the algorithm as far as when people search up live FOMC and everything like that. Just leave a like so we're at the top of that list. We're one of the only few trading channels that actually live stream the actual event, right? So we'll when the conference is on, we'll step aside, we'll put the view live there so you can see the actual press conference. It'll that way you don't have to go scour the internet for that. So we'll do that. Marco, thank you so much, man, for the awesome conversation as always. Have a blessed rest of your day, man. Take it easy.
Thank you, and see you tomorrow.
Alrighty, bye-bye.
Goodbye. So let's do a quick poll. Put it in the chat. What do you think? Is the Fed event gonna be dovish or hawkish? So I wanna get the audience read on the whole situation. By the way, if you're not sure what hawkish and dovish means that lower interest rates are coming. Hawkish means that the higher interest rates are coming. So what is currently priced in is one rate hike for 2026. That is what the general market thinks. But I want to get your guys' opinion. So in the comments, type it in, dovish, hawkish, and we'll do a quick count. Comments. What time is the rate decision? The rate decision is in 1.5 hours. We will be streaming all the way to the decision. You're gonna have Chris Pulver coming on after my segment, and then you will have Nick after Chris. Okay. So it'll be a packed day. I'll be present in the comments most likely during the conference. I want to see what Kevin has to say. Could be pretty fun, as long as YouTube doesn't start banning the comments. Okay, let's see. Hawkish, 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 dovish, hawkish, 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 neutral for Alan. Hawkish, hawkish. Model passed fund account, but got payout denied. Doesn't matter. It was a fun experiment. And I saw a question, Marco, how is your ChatGPT bot challenge going on DNA? I can show you. I know I said I'm going to bring it up, so let me just bring it up here. DNA funded. Just give me 1 second to open it in a different window because I don't want to expose my password and everything. So give me 1 second, and I'll try to transfer it in a different, in the main window that I'm sharing. So, oh my God, I'm getting the 2-factor authentication. So 1 more second. Let's see. Okay. Logged in. Let's now bring it up to this window. And it should be visible. So I haven't done an update in a while. I'm down $1,000. So this challenge is purely traded by ChatGPT, which is a challenge I'm doing for my YouTube channel. I'm down 4%, and yeah, ChatGPT has just been break even in the last two to 3 months. Not really some great results, but I've had this case in the past. So if you don't know what I'm talking about, so for the last, I think, 13 months, I have been testing out ChatGPT trade signals on the S&P, on a currency pair, and on gold. It made around 46% so far. And often it has periods of drawdown. So those periods last anywhere from 1 to 3 months. I've had 2 big drawdowns so far. This is going to be the third one. Waiting to see what happens. Will it go to like minus 20% or will it go back to all-time equity highs? We'll see. I'll make an update on my YouTube channel if you wanna follow that. So my YouTube channel is Marco's Trading Journey. Let's go back to the charts. Carlos says, thanks, Marco. Today I requested my payout on 5K DNA giveaway. Awesome. Congrats. That's really good to hear. Waiting for the video series. Go to my channel. I do have the last video on there, but I hadn't made an update in a while because the results have just been break even or negative. Ballout says, hello, Ballout. ChatGPT, Marco, waste of time. Good clicks, though. I mean, it's all about the series for the YouTube channel. It's for the engagement. I'm not really taking it super seriously. But it's fun. It's fun. And people like that sort of stuff. So Rabbi says 75% hawkish, 25% dovish. Did I hear Alan yesterday say dollar is super bullish? I think Alan is net bullish on the dollar. Yeah, he definitely is, but he's looking for better entries. So he likes USD CAD. USD CAD. Which I do like as well. Absolutely. I think the CAD is a very weak currency at the moment. The economic data is bearish and it's not looking great out there for Canada. So if you go to top setups, we can check out USD CAD. Neutral net score, but if I look at more long-term analysis, which looks like this, so let's check out the heat map first, which is short-term analysis for Canada. It's actually more bullish than bearish. That's nice. Well, it's not nice for my view, but it's good for Canada at least. What I'm looking at is the long-term numbers. So for the long-term numbers, if we type in GBP, not GBP, but CAD. Okay, we look at the CAD. Not such a pretty story. So negative prints, not really great. The main issue is actually the unemployment rate in Canada. Look at the CAD. The unemployment is on the rise. Let's look at the last 2 years. So in Jan 2024, it was 5.75%. Now it's at 6.6%. And if you look at the housing market in Canada, the housing market is falling, and Canada's economy heavily relies on housing. So if housing prices are falling, the economy is suffering, and the currency at the end of the day will suffer, because if there's less demand for housing in Canada, there's less demand for the Canadian dollar. Makes sense. So what do you need to buy a house in Canada? You need Canadian dollars. Let me see. What else do we have in the comments? Marco, what do you think of Aussie pairs? Makes sense. Good luck with it. Thank you, Ballout. Try Higgs field. You get multiple engines for image creation or free pick. Magnificent. Okay, I guess that's for Alan, I think. For the Aussie pairs, I don't have a strong enough view when it comes to the Aussie. I think Aussie is one of the stronger currencies, but I don't think it's as strong as the US dollar. I think the US dollar is much, much stronger, right? But if you can pair the Aussie, let's see, Aussie NZD with some weak currencies. Yeah, okay, Aussie NZD, Aussie CAD. Yeah, you know, still going up overall. And what do we have? GBP Aussie. In my opinion, the weakest currencies right now are the British pound, Canadian dollar, and the New Zealand dollar. Selling pound Aussie, I don't know. Personally, I think you have a much better edge in looking at GU, in looking at selling EU, I think is good as well. Selling NU and buying USD CAD. The worst one out of those is, just because of the technical analysis, USD CAD. So USD CAD, I would like to see a pullback to the 20 MA first, a bit of a correction, although I don't think we're going to get it. This train seems to be going up, and there doesn't seem to be a lot of bearish price action, a lot of opportunity to get in. It happens sometimes. I think pound Aussie was a great example. I was looking to sell the pound Aussie in the last few months, and we just melted lower. We never touched the 20 MA. Once we did touch it, we completely reversed. So yeah, no opportunity, no real opportunity there if we don't get a clear correction. I do want to mention the sponsor of today's video. So if you guys are looking to get funded, Ola Prime is a great option. We have a 35% off code, which is A1 Live. So let's put it in text. A1 Live gets you 35% off Ola Prime. The links are in the description of the stream. What I like about Ola Prime is the Trustpilot. So 4.5, that's a pretty good score, especially in the prop firm space. That score is pretty high. 2K reviews, reviewed by Deloitte. Those are some green flags. The second green flag is that on some account types, they don't have the consistency rule. The consistency rule is basically that you can't have a day where you make massively more than all of the other days, right? And if you're a swing trader, you know how problematic that is. So that's what I like about Ola Prime. With a 35% off code, you get a great price and much better than FTMO. FTMO is more expensive, and I think in terms of reliability, they're both close to each other. What could be the range for USD CAD for the next 2 weeks? If we look at the dollar CAD a bit more, so if we look at the dollar CAD, my forecast is bullish, definitely bullish. I don't think we're going to be stuck in a range. If you're thinking of range of movement, like, I don't know, this maybe. So it's tough to say. I just know I'm focusing on buy setups on USD CAD, and I'm going to be looking for those opportunities. If we pull back to this support level, I think that could be a nice entry. I think Alan would agree as well. So that's how I'm looking at things. I'm trying to keep it simple, not trying to put any targets or any ranges of price. Just want to get in on a better price, cheaper price. Kevin Warsh will be neutral, but the dot plot will give it the hawkish touch. That's how I'm looking at it. I think for Kevin to be hawkish, there's a very, very small chance he comes out hawkish, because he could insult Trump, and Trump appointed him, so that could create a whole sort of debate debacle between Trump and Warsh, which would give off some bad vibes right at the start. So I think Kevin, the best thing we can expect is for Kevin to be neutral, right? He may as well be dovish, but I think there's a high chance he just stays neutral. He does the Powell thing, which is a wait and see. We don't know yet. We don't know anything. We're waiting for data, blah, 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 blah. A boring meeting. But the dot plot is where it's at. So I would put my main focus on the dot plot. That's why I'm mostly looking at the dot plot and not really at the press conference. The dot plot should go up a bit. Now, if I show you what the dot plot is, Fed dot plot, this is it. Okay, if we open that image in new tab, can we get the latest dot plot? Yeah, March 18. Okay, yeah, this is it. So March 18, 2026. This is the old document. What you're looking at is for this to get revised up. That's what I'm thinking happens. Maybe not for 2026, but for 27. You know, at least some points to the upside. All of these dots are votes. So there's 12 committee members, and all of them, they come together and they vote. What do they think? So here, for example, they were thinking to put the rate in the longer run to 3.0, right? So this is the document. What I'm looking at is that these dots get revised a bit higher. In my personal opinion, it would be a bit crazy if the dot plot turns out dovish, because inflation is too high. Like if you go back, I don't know, 5 years, it's not like after COVID levels, but it's still the highest it has been in the last 2 to 3 years. So 4.2 and rising. If you look at the PPI, it's even worse. Usually the PPI is the precursor, so there's a lead lag relationship. Take a look at the last 5 years if we can. Yeah, so it's not as crazy as in 2022 when they printed a bunch of dollars, but it's still super high, 6.5. That's really, really high. And they could come out and say, like, look, the deal is near. Trump is talking about a deal this Friday. It's going to be done. The inflation will fall. But the question is the inflation coming because of the oil story, or is it coming because of something else? So what is the big catalyst for inflation? I think it's mainly the oil story, but you never know. It could be something else. So they need to be careful. Marco, do add position on winners. What type of trading do you do? I'm a swing trader. I focus mostly on swings because it gives me a lot of time to do some other stuff. And personally, all of that fast execution never really fit my personality. I do have a lot of accounts that I'm running. I could use a trade copier, but different brokers, different prop firms, they offer different asset classes with different names. So even with a trade copier, it gets super complicated. So for me to be super fast, I would need to have one aggregated account with all of the, let's say, capital in that. Swing is easier for me. I'm a content creator. I work for A1, so I have other obligations. Plus, if you read the latest Market Wizards book, which I highly, highly recommend, most of the guys that are interviewed in the book, they started out as day traders and have switched to swing trading, and they actually made even more percentage. So it's not like day traders make a bunch more percentage than swing traders. You can make a bunch of percentage even as a swing trader. So yeah, that's how I'm seeing the situation, but it is a good question. In terms of the watch list, I have GU. I have a position running, which was a signal in the A1 Discord. So if you want to join the A1 Discord, you can use the code Marco to get 25% off. The link is in the description. You can also join for free, by the way, to test it out. So this was a signal currently at break even. I had a previous short, which ended up being a nice winner. I'm trying to do the same thing again. So far, it's not working out, but let's see the Fed meeting. I have USD JPY, which I'll sell at 161 because at that point, I think the chance of an intervention is very, very high. I have the Nikkei, which I missed the dip. I missed the dip in May. I missed the dip in June, but it just didn't fit the plan. Edgefinder was neutral, so I have to wait for another dip, right? And if the Fed turns dovish, we know that it impacts the equity world or equities all over the world. So we know that there's a huge correlation between the Fed and the Nikkei and the S&P and the Nasdaq and the FTSE and the DAX. Pretty much everything is connected with the Fed because other central banks, they tend to follow what the Fed is doing. For the Nikkei, I'll be more aggressive with entries if we get a dovish Fed, meeting. So yeah, that's on the watch list as well. 3 things: keeping it simple, keeping it mostly flat going into the event. It's a big one, could be really volatile, could be really boring, but you have to reduce risk before such an event, unless you have a clear edge. So unless you did the work, you did the research, and you know that there's a high chance of the Fed doing something. Personally, I think it's more likely to be hawkish, but it's the first meeting with Warsh, and I'm not sure how the markets will react to his commentary. So because my edge is not that high, I'm mostly keeping a flat book going into that event. How many pairs should we trade? Personally, I trade a lot of things. Everything that you see here on the list, I'm trading. So what does that mean? That means currencies, that means indices, that means metals, crypto, oil sometimes, bonds. Yeah, bonds. I'll do TLT as well. And also I'm starting to dabble into stocks. So stocks like, for example, Caterpillar. This is the trade that I'm running at the moment. Small risk, just a feeler position. The main strategy is basically, so you have an uptrend on the daily chart, and then you're waiting for a consolidation, and you're waiting for a breakout out of the consolidation phase. Very, very simple. Trend following one-on-one, only the daily chart. The key is not to get an aggressive pullback, but to get an actual consolidation. So the best stocks I found were CAT, Palo Alto, which had a breakout as well, Global Foundries, again, consolidation, looking for a breakout, Snow, looking for a breakout, CrowdStrike, breakout, looking for it, Fortinet, looking for a breakout higher, and I found these stocks on Stockbox. So if you go to the technical screener, you go to the bottom, you have the heat maps. And I basically went through all of the weekly, monthly, and you can do the daily as well, heat maps or stocks, best performing stocks. And there I found most of the things here on the list. So once you have that, you can find the stock you like, you want to buy, and then you run it through the stock box. So Fortinet, let's go to the scorecard, FTNT, score of 3, which is not yet bullish. I think it's considered neutral. I think a score of 5 is considered bullish, and it gives you a breakdown of everything. So this is a great extra confluence to have. Yeah, neutral. But I think Intel, let me see. INTC, no, that's a score of 4. I think that's Intel. Take a look. INTC. Yep. So that's kind of the final thing, a confluence from the stock box. If you want to get the stock box, code Marco. Code Marco gets you 25% off, and the link is in the description. How much percentage on average? How much percentage do you average a month? And is 3.5% per month good? I make, I don't know, I would have to check, but 2%, 3%, something like that. I do have a track record running on DarwinX. So I think I'm up 12% for this year, or maybe 13% for this year. So yeah, maybe 2% per month is what I'm averaging. 3.5 is awesome, amazing. If you look at most hedge funds, they cannot beat the S&P. And the S&P returns around 10% per year on average. So if you're making 3.5 per month, you're already beating most of the hedge funds out there. And I think that's amazing performance as long as you can keep it up. Okay. Incognito says, no, bro, you're weak. We need Nick. Nick is coming in 45 minutes. So yeah, you'll get Nick a bit later. I think the most likely outcome is a non-event. The market won't do anything because it will adopt a wait-and-see approach. I think actually that makes sense. I think the highest I think the highest chance is for a wait-and-see approach. So I'm with you on that. But if I had to pick, I think it's more hawkish than dovish. End the stream, you're weak. Where's Nick? On the dot plot, is there significance to individual dots or only the clusters? I would say clusters. You have these clusters here, okay? And essentially, you're looking at where most of the votes are located at. So you're looking at the average. If you look at 2026, this is the last one. This was March 18, 26. The average would be somewhere between 3.5, 3.5, I think would be the average. Yeah, 3.5 or sorry, 3.4 seems to be the average. Here you would say 3.1, 3.1, 3.1 as well. I would say, yeah, 3.1. So that seems to be the longer run average. It's not that hard. Just a visual, just a visual draft, right? So a visual assessment. Sorry, let me go grab a glass of water. I'll be back. How do you manage risk as you trade the S&P 500? So S&P 500, well, the way that I trade assets with positive skew, and this is an asset with positive skew, which means it goes up over time. I usually use a trailing stop loss, so I don't have a fixed take profit in mind. I just trail the stop loss as the price keeps going up. So I can give you an example. If I zoom in here, and let's say I take a position right there with a limited stop loss, and the price appreciates, I'll just keep on moving the stop to the upside. Right? Like this, below the swing lows or below the 20 MA. That's actually the preferred approach. So below the 20 MA. That's how I manage risk on an asset like the S&P. So an asset that goes up over time. FOMC up or down? We don't know. Gold thoughts and pound Aussie, please, regarding pound news and dollar FOMC coming up. Yeah, pound news actually came out. So let's go to the news calendar. In my favor, the CPI came in. The CPI came in 2.8, and the actual number 2.8. Okay. So the inflation is lower. Now, why would that be good for me? Because it does enable the Bank of England to be more dovish. Okay, it does enable the Bank of England to be more dovish if the inflation is lower, if inflation is lower than expected. So if it printed at 3 or above 3, that would be bullish. The usual effect is, so if you look at inflation, actual greater than forecast is good for the currency, right? But actual lower than the forecast is bad for the currency. And if you look at the forecast, 3%, you look at The actual number 2.8. So came in lower than the forecast, which means that is bearish for the currency. Thoughts on gold? Gold. Okay, I'm going to do gold, and then I'll pass the stream to Chris. In my opinion, this could be the bottom for gold. I did try and participate. I tried to get in near 4581. Stop loss was hit. We crushed this level of, we crossed the level of support. We seem to be holding now, and I know Alan is in a long position. Personally, I'm not looking to re-enter. I think this could be a bottom. I think we could appreciate maybe even near all-time highs, especially if you get the end of the Middle East conflict and you get the central banks to buy gold again, because I know during this period a lot of central banks have been selling gold, which in time of crisis, central banks, they sell gold. So they could be buying gold again. You have demand coming out of China pretty much continuously. So there is fundamentally a bullish case for gold. I did try and take a buy position. It didn't work out, so now I'm being patient. That's it for me. Thank you very much for watching. You can find me in the A1 Discord. All of the information is below. Do not go anywhere because we have Chris coming on in 30 seconds. So yeah, good luck and see you tomorrow. Goodbye.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat and you can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show.
What's happening, everybody? Happy Wednesday. Nice to be back. Thanks, Mark, over that Passover. So taking a look at gold, we have the Fed coming at you hard with the new Fed chair, Kevin Warsh. I just finished up a live session and had a really good back and forth discussion on just kind of something to anticipate for this FOMC meeting with the new Fed chair, and thought I'd share some insight. So how many of us think, and just type it in the chat for me, how many of you think that Fed chair Warsh is going to lead with something hawkish or dovish? Type it in the chat. Hawkish or dovish? And I say that because if he leads with dovish, I think the market takes it positively, whether it's today, actual price action today, or it is, after this OPEX and we still see the market trying to inch up to all-time highs. So I'd say if we're dovish, I think the market does find a way to go to all-time highs. And that dovish narrative may be something to the fact that the U.S. economy is resilient. We're proving that. We're the biggest economy in the world. We're the best. I mean, if it sounds very much like a Trump teleprompter, I don't think Warsh is necessarily that guy. But if you're coming in as new Fed chair, do you want to throw a turd in the punch bowl and really piss off the market day one? Whether you are a hawk in dove's clothing or a I don't know where he really lies, but everyone thought that Warsh is going to be way more hawkish. And so I'm seeing here hawkish. Okay. Well, hawkish, if he leads with hawkish, and this is how he wants to start his day one legacy, I do find that more difficult to believe. I mean, I think that if on his first day or first week, he can help propel this market to new all-time highs within 1 or 2 weeks, and we can finish out the month high. Look, let July be the correction. Let July to August, September be the correction window. I mean, look at this. This is seasonality. So, I mean, nobody be blaming Warsh if the market goes up to all-time highs this week or next week, and then all of a sudden we have a correction on something else. Like we sign a peace deal, and all of a sudden it's buy the rumor, sell the news, and for some reason, oil catches a bid, but the markets go down. We watch and see where the technicals play out on semiconductors and all the things that have been leading this narrow rally to the upside. I could see that being a buy the rumor, sell the news type trade. So I really thought he's like, well, if he wants to be less transparent, more stoic, the playbook was more like Alan Greenspan, which is give the people nothing, right? Like you say things and you don't want them to understand what you're saying. You do away with the dot plot. You take away Fed transparency. I mean, that is like very, very disruptive to what people have grown accustomed to, watching the Fed every single month. So if that's what he leads with, sure, I'm sure the market doesn't love it. But if he can lead with something that the market's like, hey, the Kevin Warsh guy stepped in, the market went to all-time highs. Good for him. I mean, great. I still think the market has turbulence and volatility ahead. And this is why I kept going back and forth on this broadening pattern, because if this is what it looks like, where we do hit all-time highs, okay, only to see that we still have resistance ahead and we pull back maybe in the middle, we pull back maybe all the way back down to fresh lows, and we have something else, some other catalyst, some other news, news window of 2 weeks, whatever it is. I mean, last week, I know the markets were up and we had a huge gap over the weekend because we, inked the deal with Iran. It's not a deal. There's still 60 days to go back to give us a window to just negotiate all over again. So this constant, the war is done, the conflict is over, every party's happy. It's not true. But the market keeps listening to Trump, and he can single-handedly backstop this market like no other force I've ever seen. So good for him. And he's going to keep doing it, because his best chance going into midterms is going to be pumping the stock market higher and somehow telling people and telling voters that we are here to listen and here to put more money in your pockets. And as a business owner, I'm sure that's very true, because tax breaks and tax cuts, and if you did taxes this year, you probably got more money back than you thought. I mean, I rarely ever get money back, and I had a refund this year for the first time in probably 15 years. I'm like, okay, it's noticeable, but does that change my vote? Not really. But looking at, populist type programs where it's like, are the Republicans about to get way more populist driven going into midterms? They need to see the stock market all-time highs to brag to the upper end of the K. They need to have something in place where, hey, look, here's your AI investment, America. Here's your America's 401k. Here are your Trump accounts for your children, America, right? Something to help. But people need help like right now, right? People need wages that are sustainable, jobs that can pay better, jobs that are available if you wanted to leave and go to another job and actually make more money. I mean, that's where we're not at. We are seeing layoffs and a pause cycle, and it's, the no hire, no fire. Meanwhile, we know that tech is deleveraging and tech is laying people off. So profit margins are as good as they've ever been, but we have concerns there's going to be a CapEx spend, right? So in the amount of like shameless enrichment that Trump and company are providing for insiders it truly is baffling. I mean, I'm sure presidents do very well, as president, and after presidency, they do very well because they are now citizens and they're, they've been president of the United States, one of the most powerful positions in the world, and they do just fine. But never have I seen a president come in and enrich himself and his family and his insiders to the degree of like, it is shameless and it's in front of our faces. and we're just supposed to be happy about that. It is really, really perplexing to me that it's like, this is allowed right now. And nothing sticks to this guy. So it's a weird time in US politics. And this isn't a political conversation. Like, I am a green and red person, not a red, or I guess green and red wouldn't be right, because that's, red is one of them. It's markets are green. Markets are green. My tie is purple. I'm not Republican, Democrat. I think politics are a joke. I think it's noise, and it's been as noisy as I've ever seen it. And it is now very, very invasive in our markets. But to the credit of Trump and his ability to backstop things and talk things up, whether it is BS or real, the markets like going higher. And he, of all people, is fanning. He is fanning the flame to keep these markets pumping and pumping and pumping. So there is a Trump backstop. There is potentially, and this is the question for Kevin Warsh and the Fed, there is still a Fed backstop. I just think that the Fed backstop is way lower than Trump, right? I mean, the market's down 5+%, Nasdaq's down 8%. Trump comes in and says, we have a deal. And the market listens, right? And it's done that pretty much for the last couple of years. The market listens. So like I said, I'm curious what everyone is saying as far as dovish or hawkish for Kevin Warsh. I think what's going to be interesting is day one as Fed chair, this will be remembered. I mean, if he leads with a sell-off, I mean, honestly, he could say the most dovish stuff and the market could still sell off. And people will remember, well, when Fed chair came in for, Warsh came in for the first day, the market sold off hard on his speech. So they'll still blame him for it. But if somehow the markets are up, back up towards 7,500 or 7,550, 7,600, maybe breaking highs at 7,620, and we're hitting all-time highs in the next, week or two, then that's that's the start of his legacy. He came in, he gave his little spiel, whatever it is, whatever angle he's going to take, and the market somehow liked it. And so I think for him to do that, he's probably going to lean. I'm thinking he's going to lean a little bit more dovish because the market was already painting him as a hawk. But it's a huge unknown and it's a huge uncertainty. And the fact is, nobody knows. The one thing we do know is that the Fed is not doing anything right now. It is going to be a pause, and it's going to be a pause for the foreseeable future. One thing that we need to continue to watch, and you can see this in your Edge Finder, but when we have the BLS data every month, that has gone from about 2.3 to now 4.2. The one thing I keep using Truflation for is when we were going down on Truflation, BLS data and CPI headline and PPI headline were coming down. When we started to bottom out and go up, CPI, PPI, PCE all went up. So this isn't the perfect catalyst, or this isn't the perfect data to say, well, inflation is only 1.8%. Well, not according to the way the government reads it. The government data, the inputs, the core, the super core, however it's still 4.2%. So what we are right now is we're sideways. And so are we going to see this go back down? Well, I'd expect the inflation's talk to improve. If we see this go higher, I'd expect the inflation talk to get worse. And that does put the Fed in a corner where they probably have to raise rates. Okay. One thing you can see that happens today, dovish or hawkish, would be what happens to the 10-year yield. Scott Bessent Company, the entire global markets that are watching the bond market carefully, if we see yields going lower, that's a good sign. Yields going lower, bonds going up, catching a bid is a good sign. Okay. We can have stocks and bonds going up together. It doesn't have to be, well, it's a trade-off. It's like equities go up, bonds go down. Look, if yields go up, I have bigger concerns that we are going to choke out the growth in the markets. And I put this in from one of earlier sessions. Right now, I think the market this is like a traffic light. Right now, the market is able to digest the current rates. If we're staying below 4.6, the markets can it's not perfect. It's not ideal, but the market can deal with it without the shock. So we're in a green light zone. Okay. If we get above 4.6 in the 10-year, I think that's where the yellow light comes in. And the market has to realize that borrowing and rolling and looking for new debt and looking for new runways of cash is going to be harder and harder to borrow and come by. Therefore, it's starting to put caution on growth. And if we break 5%, I think this is where growth stalls. And this is where liquidity stalls. And this is where we have, potentially, I listened to a really interesting podcast with Fudge. I think it was Market Huddle with Kevin Muir and Patrick Resonant, and they brought on a guy from Excess Returns. But he talked about the Wile E. Coyote moment, which is when Wile E. Coyote, the old Roadrunner cartoons, when he would run off the cliff and he's way out here over the cliff, he didn't just fall, right? He ran out, 30, 40, 50 steps, looked at the camera, looked down, looked up at the camera, put up a sign, and then he fell. And so we could have that moment. I'm just using this guy's analogy. We can have that moment where the market might be right here, and we can keep running out on the cliff without realizing, oh crap, there's nothing to help us. And we could be up to, 8,000 S&P before that happens. But at some point, I think the markets will have a reality check, and we will have like a CapEx bubble, and we will have a secular bear market. And I do think that's coming in the next 5 years. Something I'll be prepared for. Am I trading it right now? Am I preparing for that right now? No, but I'm managing risk. And that is the most important thing, is having dry powder and just being flexible with the markets right now. I do think we are joining into a regime that has tail risk that is heavy on both sides. So, could Kevin Warsh spur a tail risk to the left and then all of a sudden be, lashed out on by Trump and True Social and say, like, what is Kevin Warsh? Probably not. It's like, that's another thing I'd say he's leading with something a bit more dovish, because, do you want to be like Jerome Powell was the last 6+ months, which is just getting berated online and being trolled by the president of the United States and saying that, too late, Powell, the Fed sucks. They're do away with the Fed, whatever. There's no etiquette there. And so again, I think Warsh would step in and probably be a little bit more dovish than the market is painting him to be. Just because I think the legacy to start things off on a happy note is probably a little bit easier than stepping in and just taking a crap in the punch bowl, and all of a sudden everyone's going to have to deal with a lot of volatility. So just my 2 cents. Okay. But if we see what's happening with Truflation, we'll get a read on what the monthly CPI, PPI, PC is doing. It is kind of surprising that right as expected, 4.1, 4.2 comes in right as expected. But this is what I'm watching in the background. If we stay sideways here, very little change in the inflation part. If we start to fall lower, then we probably see 1/10 to maybe 3/4 improvements. If we start to go higher, same thing, probably 2, 3, 5/10 to the upside. It's going to make it harder and harder for the Fed to justify pausing if inflation is ticking higher. Right now, the Fed is already getting enough free mileage out of just talking about pausing. The whole world around us is raising rates. We are not. If the U.S. is going to raise rates, it's likely December or starting in 2027. The markets haven't really priced in a Fed hike cycle. I think that's why the markets are currently digesting this idea that maybe we do hike rates, but maybe it's a one-off hike, right? We hike once, we let inflation just kind of run the course. We see how it gets. We see if it gets worse. And if it improves, then we start cutting again. I mean, it's a really interesting, it's just a really interesting time with fiscal policy that continues to run hot and monetary policy that right now is just on pause. But I don't think we have an aggressive hike cycle. I think the Fed is going to do just enough to kind of fan the flames in the market, but not necessarily pour gasoline and light this thing on fire. So we'll see. Kevin Warsh, why was he painted as a hawk? Because he's talking about trimming the balance sheet. He's talking about removing transparency and dot plots. There's going to be more dissent in the Fed, I think, with him at the helm, maybe, unless he can whip everyone into shape and they're unanimous at these FOMC meetings. So all this is up for debate in the next maybe 20 to 30 days as we all assess like what the markets just did after Kevin Warsh on Wednesday the 17th with his first Fed meeting. Okay, so there's my spiel. Dovish, hawkish. Curious where y'all taking your stance, and then we'll see what price action does. Because ultimately, whatever he says or does, it just matters what price does. So I still think the market could lead with a slightly higher high. We could still break highs and drift up here. But I've actually got a pretty interesting trade set up that you'll see in the Pulver alerts. But I'm going to take a trade up here that's going to be pretty low risk, and it's going to be built this way. I'll take defined risk, I'll put in a profit trap, and I'll have a credit. And what this allows me to do is maybe build like a $10 to $20 profit trap. And I could still make maybe, let's say, $200 to $500 here if price falls. And my risk is going to be somewhere about the same. Maybe I'm risking $200 to $500 here, but I can have a profit trap. If we just stay near these highs, I can have a profit trap of maybe $1,000 or $2,000. But if we go down, I can pull in, some tail credit and actually make some profit. So that's the trade I'm willing to take to kind of short term, maybe see the market stall through July, August, just see a little bit more indecision and turbulence. And maybe it has nothing to do with Kevin Warsh. Maybe it has nothing to do with Iran. Maybe it has something to do with something we're not even talking about. I keep talking about the Japanese yen for crying out loud. The BOJ just raised rates to 1%. The dollar yen hasn't done anything. We've had how many interventions? 1, 2, 3 in the last 4 or 5 months. Not to mention what happened in summer of 2024. It wasn't really an intervention. It was just the market thought the carry trade was unraveling. So, I mean, as a technical trader on the dollar yen, I mean, I swear this is going to be a good trade at some point. But until this structure breaks, until this trend line breaks, until this market's able to clear some of these lows, I just don't know if this confirmation is ever going to come. And it might do this, and it might spend time doing this and this and this. This could take months. But maybe by the end of the year, maybe this thing does become a trade, and I'd like to stack up some sell stops and see this thing like really sell off to 140 again and make 2,000 pips. But I would do so with a sell stop and then get the break even in and just let this thing fall and bear flag until I hit my profit target. But if I don't have that confirmation, I am a fool to think that this market's going to be Japanese yen strength. Because one thing the BOJ probably likes right now and the entire economy is that the Nikkei is going to all-time highs. So, I mean, it was in a drawdown since 1989. And right now the Nikkei is up to all-time highs and still pumping. And right now, year to date, why am I not getting year to date? Where are we at? Year to date. Is that right? 39. Is that right? Oof. I got to see that. That can't be right. Let's go to the 12-month. Holy shnikes, man. The Nikkei Is this up 40% for the year? Good Lord. Okay. That's impressive. I knew that South Korea was killing it, but man, I did not know the Nikkei was up 40%. Well, the good thing is I have FX, what is it, EWJ. That is not up nearly the same, but my gosh, at least I'm getting some benefit from this. So there's my year-to-date EWJ. So that little ETF holding is up around, embarrassing, 17.38%. That's supposed to get rid of the bottom 15%. What a crock. Anyway, that's nuts, man. All right, so foreign markets doing okay. Here's some of the global trades that I also look at. I'm in VT. This is reducing some of the U.S. exposure. Year to date, it's up 11.43. A little bit more resilient. It's mostly stocks, but you can see some North America exposure, Asia, Europe. Also, there is one. What is it? ACWX. ACWX. That is basically the world without the U.S. And this one year to date is up 13.7. This one is made up primarily of Asia, Europe, a little bit of North America, Canada, Mexico, elsewhere. But this is your way to say, if the world can just catch up with fiscal policy, the world does okay while the U.S. figures it out. I still think the world has to be resilient, or the U.S. has to be resilient for the world to grow. But ACWX, I mean, it's up, matching the S&P, and you have no U.S. exposure or very little. But at the end of the day, we're all connected. Like, you think that the world is going to go up all by itself with zero U.S. growth? You're probably wrong. I think the U.S. has now reasserted itself as one of the best markets in the world. A lot of people talking about, the U.S. is going to underperform. The world's going to be better. Invest here, invest here. The reason I'm doing non-U.S. trades right now is not because I don't believe in the U.S. It's because I think when you have low valuations, you have room just to go a little bit better. If Europe just does a little bit better, the market can perform. If China just does a little bit better, if India just does a little bit better, if all these non-U.S. plays just do a little bit better, this can do a little bit better than the U.S. So, I mean, the U.S. is crazy, man. I mean, XLK with its run that it had, semiconductors and SMH and all those computing stocks, and it's crazy what we saw from April, May to drive that 9-week bull market. I mean, it was literally like the 100th percentile bullishness. We have not seen a run that aggressive since like 1965. So it is what it is. But like I said, it reasserted the U.S. is like, hey, U.S. is still here. It's a tour de force, and it's still a great market, and there's still plenty more to go. There's more room to go, right? So all that bubble talk, all that high valuation stuff, look, we still have expensive stock market. Even historically speaking, we still have an expensive stock market. That doesn't mean there's not more upside. It just means that the asymmetry is not necessarily to the upside. I think it is more remain cautiously bullish until price action and the news narratives break down where it's just like permanently bad news, or there's something exogenous that we don't see coming, like a black swan, and I don't know what that is. I think if we did, we'd position for it. Anyway, all right, let's go some other stuff. Let's talk currencies. Let's talk gold, silver. I heard Marco when I came on that he took a bid in gold. Look, I like gold. A lot of my positions in Pulver Alerts are selling puts, ratio spreads, naked puts, cash secured puts, accumulating. I want to own more gold. I want more gold physically. I want more gold in options. I'm trading GLD and GC. I'm trading CEF and PHYS. I'm dollar cost averaging. If gold goes lower, it's fine. I am prepared for a 50% drawdown in gold. I hope we don't get one. But if we do have one, I'm going to hopefully, gladly own some stock in GLD, and I'll correlate with the spot price. And I hope that if I own some stock at 50% off, that if we get back to all-time highs, there's a 100% gain in my gold position. And I'll get that accumulation back up to probably closer to 10% of my portfolio. It went from between silver and gold, I probably had about 20% of my portfolio long gold and silver over the last 3-4 years. This mania that we saw late 2025 and into this year, I took all that down to 0. So I took all that profit. Now, when we dipped here, I took some profit along the way. I did dollar cost average back in. So I had a little bit of that run, but now we're essentially flat. Okay. So going from the chunk that I had allocation-wise to 0, I'm now building it back up, where I'm probably looking at, realistically, if I'm assigned down here, I'm probably getting closer to that like 7 to 10% allocation. If I have all income here, I'm probably looking at generating maybe 5+ % gains on my portfolio with gold. If I can do the same thing in silver, that's great. But if I own the shares and we go back to highs, that's a 100% rally if we get to that 50% drawdown. If silver does the same thing, I'm looking for the same type of trade. If we go to a 50% drawdown, and right now silver has had a pullback of 49%. So I have shares of SLV. I'm buying shares of SLV, and I know that this may come back deeper, right? This might be a 60 to 70% pullback, but I'm going to start here, start working my way back into silver. And if this goes up, I'm going to keep it open. I did a diagonal spread in the Pulver Alerts where I bought a 40. I rolled, so I had 40 by 85, and that $85 sell call was a 98% profit on the covered call. It's a poor man's covered call. Now, to the upside, what I did is instead of rolling this, out 30 days and keeping it at 85, what I did is I just rolled it out to the end of the year, and I went all the way up here to the highs, and I've got now a 120 strike. So I keep the 40. I've lowered my cost basis by $5. And if I get the stock called away, it's going to be all the way up here at 120, giving me an $80 credit. And that's a lot better than $45. So my net cost is about 35. If it goes up to 120, I get it called away. What is that? $85. I make $85 a share, and I'm out to like 2028. So I can manage this with a call side option, and hopefully see, maybe silver catches a bid and we have a, really nice bull market here in the next maybe 6 months. But it is being patient. I don't think that we should be just expecting like that's the bottom. Look, if silver comes up here and breaks this high, we could have a pullback and then a run. We could have a deeper pullback and then a run. We could have a range trade, and this becomes more of like the saucer bottom or the big rounded bottom. But eventually this breakout level above 90 gives us a firm chance to maybe go to that 110, 115, 120. But there's going to be time for that trade to develop and time for that price action to develop. Okay. So I like both of them. I've been talking about this on repeat. Like, I like gold. I like silver. I like accumulating. I'm just not in a hurry to get long. Like, I am accumulating. I'm going to be patient. We could still have more downside for whatever reason, but I still think they're good trades in the medium to long term. Bitcoin catching a bit of a bid here off the 60K handle. Look, if we have some summer turbulence where the stock market's going to dip another 5-10%, if we have a pullback, I do think Bitcoin is probably going to break 60K and go lower. Okay. My symmetry target is 32.7, by the way. 32.7. Look, I don't want to see Bitcoin go there. The narrative around it is going to be so bad, it's going to feel like, man, I shouldn't have any Bitcoin exposed right now. But I think that's also where, as a contrarian, if we come into this level and everyone's saying it's going to zero, right? I mean, if it doesn't go to zero, then I think we go back to all-time highs, and there's a 300% gain. But like I'm saying, if we have, Nasdaq pulls back maybe 10-15%, if the S&P pulls back 7-8-10%, I think Bitcoin breaks 60K. We still have this flush lower. There's my symmetry. We still look for a bottoming pattern. You wait for a trend line break. It gets a lot better on the right-hand side. Just something needs to change this structure. We are not in a bull market at all. If we cannot get Bitcoin above a 200-day moving average, it is not a buy. So even if it goes lower and lower and lower, I'm going to wait for that 200-day moving average. I'm going to wait and see how price behaves. I'm going to look and see if we get a bottoming pattern. Then we can start having that conversation about being a bull again. But it's not worth guessing that this is the bottom. I don't think it is. I think there's more pain, especially if the market flinches at the tops. Okay. Copper. I had a pretty good run on copper. I was a little miffed when we had the tariff talk from Trump and copper was down 20% in a week. I'm like, this kind of feels untradeable right now. It was a good trade though. But I take copper from FCX and Rio Tinto is another one. RIO. I got a couple stocks that I've been trading to get some copper exposure. And again, mining, like the physical side. So it's been okay, but those stocks have done fine versus just futures trade. So FCX looks a little bit like copper, doesn't it? I've been holding shares here since low 30s, and Rio Tinto, same thing. Nice little wedge break, buying stock around 70, 75. It's up to $100. Not bad. Get some exposure. So do I like it right now? If I was having zero trade, it's like I bought it down here at 70 something. I don't want to buy it now. I want to see a pullback into past resistance. and see if there's, a bid in here like 90 or lower. Or if I can go out far enough to sell a crap ton of puts down here at like $60 or $50 and see if those will still go higher. But they're benefiting from, the scarcity of copper, of silver, of gold, and it's a good commodity play. All right, what else? Adobe stock, Adobe. So before I go to Adobe, look at IGV. Okay, volatile, man. Look at this. This is so volatile. I mean, I have my concerns. Is this IGV with a massive topping pattern, or is this a strong low that the market's going to continue to defend with stocks that still make money? Very volatile in IGV. So let me take a look and say, okay, just keep that software stuff in mind as you go to something like Adobe. Adobe is not looking great, and not a single trend line looks good. I don't know. So I think I'm out of Adobe with profit. Let me double check my position here. What up, Nick? How are you, man?
What's up, man? How are you?
I'm good. I have 0 Adobe. So I was out. The Pulver alerts, we had a ratio spread. I took profits on that. That would have been that black line. I'm not sure when we got out of the trade, but most likely it was out here in like the March, April, May window, because that would have been a trade I put in last fall. But fortunately, like, I'm not sucking wind on this trade. So, I mean, do I like Adobe? Not right now. This price action sucks. If I wanted to be long Adobe, then, I mean, you got to wait for a trend line to break. I can look at it fundamentally. It probably shows like a decent snowflake analysis. I just think that the price action is suggesting just it's not great, right? So we're way below estimated value. They're not getting any AI love. They're 11 times earnings. I mean, looks great from a fundamental standpoint. The problem is this price action could make you wait a lot longer than you want. And that's my concern, is what has been not working in the stock market 2026 is not where I want any money. I only want money in stocks that have been doing better. Nick, what are your thoughts on, like, hey, this stock has sucked all year. Should I put money into it?
I mean, I'm a momentum trader through and through. Like, it's hard for me to, if I'm gonna play something for more of a value play, it has to be something where I just feel
give me a dividend.
It's give me a dividend.
Yep.
It's got to be such a glaring obvious like buy to me, even if the market doesn't think so. And that is pretty rare. Like, a lot of times the markets, do I think it's right necessarily about throwing software stocks out? No, but it doesn't matter what I think. The market right now hates software stocks. And if you're trading them, that's different, right? Like, if I'm trading software, there's not a lot of good momentum here. You had something going, like they looked like they were coming alive, and just, again, toppling back over.
Yep.
Real troubled here. The one that really annoyed me more than anything, Chris, was, I mentioned to you several times, like, my favorite spot within software is cybersecurity.
Mm-hmm.
And I missed buying the dip on cybersecurity, which has done resoundingly better than software as a collective group, right?
Yeah.
Like, this specific area, software, is the broader umbrella, but cybersecurity has been a spot that I would still like to get in on. And so if we do get, a little bit more of a pullback, I'm going to be, more willing to get back in on this stuff. Chris, what are your thoughts on, we've got Fed Day today.
Yep.
First day for Kevin Warsh on the stand there. Stocks are near all-time highs. Yields are, they're backing off a little bit here.
Yeah.
But is there a chance that we get the Fed tested? I know we've talked about that a lot. Are we going to get the chairman, tested with a situation? There's still the uncertainty around the Middle East stuff. I know this morning, Trump made an announcement that if he doesn't like the final deal, he's like, we're not too far away from pulling away if we have to from that deal if he doesn't like it. I mean, obviously he doesn't actually want to do that. Like, he really doesn't want to do that, because clearly we have been at the brink of something and then back.
So for 100 days, we've been doing this for 100 days.
Yeah.
And we've been told that the war's done 30 times. So,
right.
I mean, even last week when it's like all parties agree, Donald Trump declare this blah, blah, blah. It's not even real. Like, we still have a 60-day window to go back and renegotiate again. So it's still ongoing. But to your question on, so are we talking about like Kevin Warsh today?
Yeah, like what's your synopsis on it? Do you think it's a potential volatility event?
So I talked about it for probably the first 10 minutes. And so I think that look, if you are Kevin Warsh and this is your first day as Fed chair, how would you like to start your little legacy as Fed chair? Do you want the market to take your word and dump 3, 4, 5% the next week? Or would you like the market to take it as like, hey, this guy's not too bad, and actually take it with like a positive flow, and maybe there's an upside to it, and then the market might test him, but it has nothing to do with what he is saying to make it where he's the cause of the market dropping.
Well, which market is the question, right? Do you want to appease the stock market, or do you want to appease the bond market, right? Because if you come out and say, hey, rate cuts galore, like we're going to find a way to cut, the stock market will cheer you on, but the bond market may seriously not love that. They'll be like, wait a second, we have inflation stickiness, jobs market seems to be picking up, like there's not a reason to rush rate cuts. Whereas yes, the market itself, the stock market, will love that. I'm curious, we've got the audience here to help us out. Why not do a little bit of a poll here? Let's do
I'm going to say, so my opinion is, we saw the importance of the bond market during April 2025. I think if Kevin Warsh is really wanting to appease one market in particular, it would be make the bond market happier, so we have more liquidity, we have more like stability, and the flows will find their way into the overall markets. Like we can have windows where bonds and stocks both go up,
right?
But if the bond market keeps going lower bonds, higher yields, lower bonds, higher yields, it is ultimately going to make the market most likely break at some point, because it's like, as they say, the government can keep spending money until the bond market takes away the keys. So that can happen. I don't want to see that happen, because it's like that's the window, that's the 6-12 month window or more that nobody really wants to face. That's the reality that nobody wants to deal with, which is, holy crap, Nick, we're down 20% now, we're down 30% now. It's not stopping that we have lower highs and lower lows. That's what the bond market leads to, versus, look, keep the market stable. Like, we might fluctuate around these all-time highs, but not really do too much damage in the equities market, but we stay resilient. And meanwhile, if yields could drop to, 4.2, 4.1, maybe back to 4%, I feel like you're gonna cool down like all the escalation I think the bond market was feeling these last couple of months.
Yeah. And guys in the audience, I just dropped that poll there. If you type 1 or 2 in the live stream chat, your vote will be casted. We only have one vote here, so help us out. Let us know. Do you think today Fed commentary is going to be more dovish, pushing for rate cuts sooner, or do you think the commentary will be more hawkish, meaning keep interest rates elevated and wait before making the move to cut rates? Curious to hear you guys' thoughts, so weigh in on this. And again, we'll leave the published votes here on the screen for you guys to watch as they roll in. Chris, I think, I think I've said it kind of consistently. I think Kevin Warsh is going to be a little bit more hawkish than people kind of jumped to the thought process on. Not to say I think he does want to cut rates, but I think he seems like a smart guy, and if he's a smart guy, he won't try and disrespect his committee peers, right? Like there's a decision that is a democratic one. There's votes that go into this. Right. You can't come in there and just be like, if everyone's looking at the sky and it's blue, and he comes in and says the sky is green, it's just going to make everyone annoying, right? Everyone's going to be like, no, it's not. The sky is blue. In this case, the sky being blue is we have inflation. We don't have a strong reason to cut rates immediately. So I think he's probably going to come in and probably administer a little bit more to the bond market. That is why Chris and someone in the audience asked if I could go over gold in my thought process. So I am still short gold. But again, as always, with an idea that I have, it is not I'm married to this idea. Right now, I understand the bull and bear case for gold. I prefer the bear case slightly, but I understand that it looks like we're probably going to get a deal going through in the Middle East, which is, of course, a positive for gold because it has been held down by the rising oil prices. Oil price has been moving lower. We've been making some nice progress in oil. So that has been a lift to precious metals. However, we also still have inflation that I don't think is just going to roll away. I don't think it's immediately finished, right? We have inflation that is baked into the system, may take some time to resolve itself. We also have the jobs data that has been coming in better than expected. And just to map out a visual here, gold from a macro fundamentals perspective for me still has its challenges. We have a -6 reading on Edgefinder, which just basically says, after looking at economic growth statistics, inflation, and jobs data, how does this impact gold? Well, the jobs market has been showing some strength relative to expectations, which is what we care about, not absolute strength. The jobs market is still, still kind of quiet, but it's coming in better than expected recently. The JOLTS job openings, the ADP numbers, the NFP numbers, these numbers have been coming in better than expected. Meanwhile, we have also some sticky inflation, which could keep the Fed from drastically cutting rates, which is kind of our conversation here today around Kevin Warsh. Same time, economic growth, better than expected in PMIs as well as consumer confidence. So all of these things said and done, I think that keeps the dollar having a little bit of a bid, and that keeps me on the, cautiously bearish gold side. And I say that because if I'm completely wrong in this idea and price starts to break price action, I'm not going to fight the price action. I'm going to get out of the trade, cut the loss, and move on to the next idea. So that is for me the thesis on gold. The other thing, just to layer on that, taking a look at the 10-year yield on the daily chart, I've got this level marked up where it was past resistance. We are now breaking out and retesting once more this 4.45% area on the 10-year yield. If this starts to break, though, again, in line with my discussion of, my gold price action, if that starts to fall apart, it would also seriously challenge my gold short idea, and I'd have to get out of the trade.
So I look, I commend you for even having a bearish trade on gold and silver. I'm just in the accumulation phase. So I'm liking that we at least had a bit of a bottom, but we still haven't broken above the 200-day moving average. So it's close, but there's probably some more noise this summer. I think that I just think the central bank bids are going to be so consistent, and I don't care. Like I'm really gold immune. It's like, if it's noise, if it's bearish, if it's down 30, 40, 50, I don't care. I'm going to put it in the portfolio. So I'm not trying to pick, I'm not trying to pick individual trades right now. Certainly not trying to be bearish and it is just a tactical trade. I just want to be like, look, dude, I went from about a 20% position in my portfolio to 0. So right now it's like, I'm just trying to build back up to like 7, 8, 10%, get it into the balance that I want it to be in. And, if it's 30% off all-time highs, if it's 50% of all-time highs, I'll sign up for it and I'll hold it.
Yeah, I'm the same way. In terms of like the long-term perspective, we talked about this before. Pretty much all the time, I am a long-term bull on precious metals. In the short term, like I said, I think the dollar has a little bit of room to squeeze, and so I'm just sort of playing my dollar bullish thesis through gold. But to that point, I hope that, gold does move lower so that ultimately I can accumulate it as well at lower prices. Because again, I think that the longer term story of national debt exploding all over the world is ultimately a bull case for gold at some point or another. And, we'll keep an eye on it. But in the here and now, I've got that trade on. Like I said, I'll cut it if it doesn't work. What do you think about oil, Chris? Oil is really coming down now.
Yep. So I did get filled on oil. I'm going to throw it into, I just got filled on this morning. So I'll put it into Pulver Alerts. I have a trade. It's max risk 200. The credit that I'm looking for is I got filled for 30 cents. So it's a $300 winner if price is back above $78 in the next like 39 to 40 days. So spot price wise on oil, I'm looking to see if we dip below the 200-day and then bounce back up above it. This value is around $79. So I did like the 79 by 78.50 by 78 or 78, something like that. I'll put the exact details in. But the trade is it's an option trade. It's a broken wing butterfly. So I have $300 here. I have a profit trap that's worth another $500, and I have a risk of $200. So I'm risking 2 to make 3 and potentially give me, if we hang out around this 200-day moving average, then I have a bonus profit of $5. So I could make $800 in the trade, only risking 2. And I will do this exact same trade. If this is not a winning trade, I will do this exact same type of trade down here, looking for a bounce. And I'll build it, I'll build it around that area with the same type of thing. And most likely if I lose $200 here, I'm going to try to make $400 to $600 at the lows and see if it gets a bounce off like 65.
Sure.
So I'm gonna look for that little bid in oil that, look, the deal's not done, type thing. And also, if we have, I mean, the infrastructure damage that has happened over the last 100 days, I just feel like somehow the market is not pricing it in very well. I get that, it's nice to see oil coming down, and this is like the sticky inflation might subside a little bit. But if we realize that all we're doing is depleting our strategic reserves, and we have nothing, like we don't have the ability to start up and like resupply our global oil, I think that's a huge problem. And so I also think this is a bit of a hedge and a bit of a non-correlated play against the S&P, just to have some summer noise. So that's what I'm trying to trade with options where it's very low risk and try to make it favorable.
Sure. Yeah, no, it's been interesting. I was looking at, do I want to buy some energy stocks at some point from a longer term perspective? And I still think, you have a lot of these names that are still very, ExxonMobil is not a cheap stock. When I look at a lot of the names in the energy world, I'm like, it's one of those things it is such a contrarian group of stocks in my view. Like, you want to buy, again, just how I look at them, I want to buy energy stocks when like they are just dirt cheap and nobody likes them. And when they're pop flying, I feel like it's more often than not, just from my experience with energy stocks, it feels like the time to buy them is when people are completely getting rid of them. And when they pop, it's sort of like, you don't know how far they're going to go, but you kind of just like take some chips off the table. And a lot of them are nice dividend payers. That is the nice thing. That's the draw, the attractiveness of energy stocks for me. However, I still want to make sure I'm buying them at, good valuations, just because, again, they can also get crushed in recession, et cetera. So, I mean,
what levels you like then? If you're looking at ExxonMobil, I mean, I'm looking at, I could probably craft up a little ratio spread around like the 125 handle. I can maybe go out further in time and put it all the way down to $100 and maybe make a few bucks. I mean, I'm willing to own it. It's like we're up 80%. We're up 80% from the lows in April of last year. So from Liberation Day last year to the recent all-time highs, you're up 80%. Now, we pulled right back to the 200-day moving average. This to me is a good spot to say, well, if it's high, low, lower, high, lower, low, there might be some pain to still hit symmetry here. But I think like a 120, 130 is like a pretty good spot to look for a bid. If we hold, and this is just coming back into this cluster, then we jump back up here, we build out this bottom, and we get another breakout, and we're going to all-time highs again. Now, the AI trade, the scarcity trade, bottlenecks in the AI build-outs, the data centers, we have electricity's too high and whatever, dude. Nobody is talking about this. The AI narrative doesn't really have anything negative in the markets right now. But if we run into bottlenecks where we don't have the supply to meet the demand, I mean, if we run the energy grids hot, I feel like this has to be good for big energy. This has to be good for utilities. This has to be good for materials. It's like the scarcity side of it versus just all in chips, all in AI computing power, like the SanDisks, the Western Digitals. I can't for the life of me justify wanting to buy those things, dude. I'm steering so clear of those right now.
Yeah, I like the second and third derivative plays as well. I feel like I like that a little bit more. But yeah, I mean, when I talk index level, Chris, I'm still kind of in the camp of thinking, I have to wait for dips. I have to be constructive, no matter how challenging that can sometimes be. The risk reward profile just becomes more attractive for me on that. I am looking at like the Dow Jones, for example, if it were to, give us a pullback maybe to this area. In the meantime, I'm not going to, sit around and wait for it. Like, I'm just going to sit back. I like your concept of like selling premium out of the money on stuff that you wouldn't mind if it were to tank, get filled on it. That gives you, for me, Chris, that kind of gives me something to do. Like, that's something in the meantime, like, okay, I can work towards selling some premium on some names that I like out of the money on places that I wouldn't mind getting assigned, without, feeling like I've got to be doing something with the index, which I really, candidly, I just feel I don't have anything to do with the index right here, right now. When I look at the Dow Jones, US 30, all-time highs. We take a look at S&P 500, pretty much back to all-time highs, Nasdaq all-time highs. From a swing trades perspective, or even a position trading perspective, there's nothing I can really do here. I was looking at Nasdaq from maybe a shorter term trade. If we fill this gap, come back to the gap fill, I actually like the idea of a possible long setup here. Just with a tight stop, looking for more of a through the all-time highs. We keep pushing through those highs and maybe take the risk reward that I think is there, which could be pretty attractive in the sense that like, okay, I could define my risk. I could look for, push through those all-time highs. That trade is not the worst one out there, although I do still like better than that, waiting for a pullback into, what is this? The 8% or so pullback, like 6 to 8% pullback starts to look like. I would take some stabs there. But again, I'm in no rush to try and, make a bunch of long index plays, especially when I feel like, Chris, I feel like, we've got like some bubble territory type stuff playing around with the whole SpaceX IPO. And again, I love these things. I just
more concerned with OpenAI and Anthropic. SpaceX, I think, has at least more of a technical moat to it because it's defense, it's Starlink, there's revenue stream, it's a space economy. This is like uncharted territory. But the OpenAI Anthropic, I just feel like that's a money grab. Yeah, and the timing of like that to me is like more of the canary in the coal mine of this is the late 1999, like this is the mega IPOs coming out at the brink of like all the euphoria. But they're not going public for like, I mean, I don't even know when the official, like, I know they filed like S1s, but I don't know when they're going officially live with the IPO. But SpaceX, I did, I think I put the trade in for my alerts. I did, yeah. So I did that one on yesterday. So I put in, and again, it's a very conservative trade, but it's like the option prices to me were really interesting. The reason I didn't chase the IPO at 150 is because I don't give a crap. If it's going to the index, cool. If it's going to be in the Nasdaq and the Dow, if it's going to be in the Russell, if it's going to be in all these other indexes, the S&P said no to it. But the option prices yesterday, get this, man, we're trading at $200. Okay. I went out to December of 2028, and then I did another trade today that I'll post for Pulver Alerts. And I went out to January of 2027. I'm getting anywhere between like $300 to $500 on the January trade, but I'm getting like $3,500 out to December. Now, if SpaceX is going to see like $400 or $500 spot price later this year, my $3,500 is going to be worth like $3,100 of that profit. Like I'll see like 80% of that max profit well before expiration. But if it's noisy and we have some price discovery, we have some chop and volatility, the one thing I have concerns of is, did you see the volumes in double leverage single stock ETFs in SpaceX? There's SPCU. There's like 10 of them that launched on Tuesday, and everybody was in them. And so it was like a quick leverage pump that went up to like 225 and then dumped back down sub 200. And so like, that's the type of noise that I don't want to be in. And that's why I didn't care about the IPO price. I'm like, give me an option chain. So I went out to December, dude, we're trading at $202. And the expected move for December 2028 was $215.
Wow. So
they're pricing that it could go to negative $15. And I'm like, dude, I'll take it. I'll take a stab at that. So if I own the shares of SpaceX, it would be $63 would be my break even.
Wow.
So I'll take the trade. Yeah.
Yeah, no, it is a fascinating thing to watch. It's, there's a lot of, I think from an IPO standpoint, they did an incredible job marketing it. And the
retail crowd got a big chunk of it, which is good. It makes it a little bit different than typical IPOs.
Yeah. And it's like, as soon as this thing went public, you just saw how clear, like there was, I heard somebody talking about it. It's like in the private market, they got so much shares out into the market, but there was clearly a huge demand that had not yet been even able to access the shares until the IPO. So then you had, like you said, like a ton of retail involvement, a lot of buying of the shares. So it's interesting. And I think, will we get some kind of similar presentation when we do get to the AI names? I guess we'll see. But yeah, it is interesting because SpaceX is a little bit different of an animal. Like there is that space exploration side of it. That being said, just being the stubborn stock investor that I am, I only am really interested in a SpaceX, share purchase if we see the thing fall apart. Like, just from not even necessarily the company is dying, but rather if you just get, a couple weeks down, if you get a couple months down of just a tougher environment than we've been, living in.
Yeah.
I think.
Where do you want to buy it? Do you want to buy it like at IPO price at 150? Do you want to go lower? Like what are your thoughts on if you're going to purchase
probably lower? It would be, for me, it would be more of a time thing, not necessarily a price thing.
Okay.
If for example, we were to see the stock trade lower than the IPO point 6 months from now, then I'm looking at it, I'm like, okay, the buzz has like maybe left out a little bit. Maybe the stock price deflates a little bit. But I mean, I'm also just getting flashbacks to 2021, 2020, Chris, where it was like I would turn on the TV or listen to CNBC, and all it was space exploration hype. And I think SpaceX is different because it's got Elon Musk involved. They've got way more infrastructure, assets, et cetera. Like, it's a real thing. I just also think that even though it is a real thing, real things can also get very hyped. So I'm
and it's unproven. I mean, the reason
Yeah.
the S&P said no to it is because it doesn't have a profitable model.
Yeah.
So I mean,
Yeah.
but dude, private equity investors have made a freaking killing. Now that it's live,
Absolutely.
It's like they've got their 60 to 90 day window. They're probably going to sell. I mean, if you're made whole at 10 to 20 times your investment, I'd sell too, man.
Yeah.
You know, it's like, look, I don't need to be in it to be a hero. It's like I get in because it was a good opportunity. So I'm 10 times my investment. It's like, that's not a bad trade. That's a good investment in private equity. And, now the retail crowd would have it, but it's like the insiders that have been in it since 2009, 2008, 2007, whenever it was, like, they're going to be made whole at 10 to 20 times their money. They're probably looking for a payout.
Right. Exactly.
That's a long hold, man. If you're in that thing for a decade or more, it's like, yeah, I want 10x of my money. I mean, it's a good return.
Yeah, it's an interesting story. I'm very curious to see how the other IPOs this year go. I'm just, for me, I'm a buyer of the market on pullbacks, but staying patient with it, buying certain areas, I think in the pullback would be different than others. We've talked a little bit about that. I actually do like the Dow Jones a little bit more. Some of the more boring stuff I'd be a little bit interested in. Also, let's just take a quick look. I'm just curious in terms of some options flow here. Put call ratio for S&P 500 jumped back up a little bit more on the cautious side, but nothing extreme on this side of things. AAII Investor Sentiment Survey. We'll get latest data tomorrow on this, but just as of last week, you did have a pretty big surge in fear in the markets. So I'm very curious to see how that plays out, because it feels like in the last 1 week, Chris, we've completely, gone from edge of the cliff to things are all good again, with the SpaceX IPO going well, with the Iran stuff looking like it is potentially set to come to a close. We'll have to see. But I think it's also worth mentioning, if you're watching oil here, oil making serious progress to the downside. This is really good for inflation conversations. But I would also just be cautious because, again, we're talking about like pretty much almost back down to pre-war levels, which kind of suggests to me like, okay, the market pretty much assumes that you're going to get the war ending. If there's anything short of that, we could very quickly catch some kind of a bounce in oil prices. So, and again, we've been fooled many, many times by this, right? This like, okay, we're about to end it, and then boom, something changes. And actually, couple weeks ago, it really looked like the war was going to end, and then it didn't. Right? I think this is the closest we've been, with both sides acknowledging. But I don't think it's fair to just conclude that they're going to agree on everything and going to find the deal.
It's so noisy. I just honestly and what was annoying to me last week was watching the single day pump that happened on this was Thursday last week. That intraday move. I mean, Nick, remember the VIX was at 22 and then it dropped to 19, and this behaved like the VIX was at 27.
Yeah.
I'm telling you, like, this upside risk and what Trump can do single-handedly with a Truth Social post is insane.
Yeah.
And as somebody that trades 0DT like every single day, it's wild how much, I'm not going to say control, but like how much influence he has on the market. And that's all it took. It's like, that was the Truth Social. We drifted higher, and then over the weekend, massive gap. And we're not even done. It's like, we just paused for 60 more days. And it's like, this is the art of the deal, dude. You tell everyone for 30 straight days, it's done. I've told you all, it's over. Everyone's happy.
Right.
Even though it's not, it's just like the market look, why is the market optimistic? Because we keep telling the world we're going to have a deal. So we're probably going to find one. We'll probably make enough compromises and concessions on both sides. We'll probably find one. So that's why it's just like, it's noisy in certain days, but it's like, it's not really a derailment. I don't think the markets are going to roll over into a bear market because of Iran. I think it's just disruptive. I think that it is, it's certainly sticky inflation because of oil prices and the oil shock. But if it just goes back to normal, I mean, the market's looking for greener pastures and looking for higher highs.
Yep, that's right. And guys, so it is 2 p.m. here as we speak, U.S. Eastern time. We, of course, have the Fed funds rate just dropped, came in line with expectations, 3.75% as expected. So unchanged on the rate side of things. No surprises there. However, we do get the dot plot here as well, which Chris and I will be keeping an eye on that. We are getting some movement here, Chris. S&P lower, Nas lower, dollar. Look at gold just dropped. Look at dollar. What is going? Something was in the dot plot, Chris.
Wow, that is a big jump.
Very rare.
Okay, so the economic projections and the statement came out. So let me see if there's some headlines in the statement. Everything's unanimous on the rate pause. Inflation remains elevated relative to 2% goal, in part reflecting supply shocks that have caused price increase to certain sectors, including energy. There's a dot plot here. I've got the dot plot on my screen for Financial Juice. So near term, I'll take a screenshot here.
Dollar's absolutely ripping, Chris.
Interesting. Look, as we've said many, many times with this FOMC, Nick, it rips, but watch how it closes.
Yep.
Don't be surprised. I mean, telling you, like, you can go to a 1 minute chart on the DXY. I'll do this right now. Go to the 1 minute chart DXY, and look, more than likely, this little jump up is going to look probably like all this. If it goes for 5 minutes up, it's probably going to spend most of the time pulling back right where it broke out. So if we have a big move here, we'll see. We'll see.
First move is the fake move. That's what they always say.
Kinda. I mean,
the second move is the real move or whatever. Not always. And of course, guys, be careful out there. We're just covering it. But yeah, a good sized jump there. Gold just dropped from 43.82, just dropped about $40 an ounce down to 43. I mean, it's an initial move. We'll see if it sticks. But yeah, we'll hear from. I mean, it's
a reaction for sure.
Yeah.
It's a move. Like right now, I mean, dollar's up, yen is up. What's dropping? This looks like New Zealand is dropping, euro's dropping, Swiss is still. I mean, Swiss was high, weakened a little bit, but dollar and yen are popping together on currencies.
Yeah.
So we'll see if it sticks. I'm looking at expected moves on the day. Couple levels that I'm watching. I have a trade sitting and pending for the day. Down here, I'm looking for a rejection or a bounce at 74.25. That's a gap fill. It's unusual to see this at 2 p.m. ahead of Kevin Warsh as coming into the new Fed chair. If this is what we are dealing with as he steps to the microphone, I feel like it would be more rare to see the market continue to run with that same direction. So I feel like an aggressive move down, he probably talks it price action wise, maybe right back up. That's what I would, if I'm going to, trade today, that's probably what I'm looking at, is more of like, it's going to be a noisy Fed day.
Yeah. Wow.
But it's a big move, man. This is now another 30 plus, almost 40 points to the downside on S&P. That's not nothing.
So I've got just a little bit of a headline here. So we've got 9 of 18 FOMC participants pencil in a 2026 rate cut.
What? Cut?
I'm sorry, rate hike. I'm sorry.
Okay.
Guys, apologies. 9 of 18 FOMC participants pencil in a 2026 rate hike.
Gotcha.
And then right after that, Fed removes statement reference to additional rate adjustments. So a little bit, it seems like market's sniffing out like, okay, some private conversations are maybe tilting a little bit more hawkish. You have yields are making a move here. 2-year yield is making a jump here. Gold now red on the day. Stocks just down 0.5% for S&P. Nas is down 0.25%. I mean, again, we've done this, Chris. You and I have done this segment of the show for years, and for so long you have seen this pattern emerge where you get the market freaking out about something in the meeting minutes, and then or the dot plot, etc., and then you get the walk it back on stage. So maybe we'll get that. But again, what are we going off of? We have not a lot to go off of. We have not had Kevin Warsh on the stand before.
Correct.
So and remember, let's think about this. We're used to a Powell who gets on there and says pretty much both sides. He kind of satisfies both sides of the mandate without saying much of anything. I mean, I like Powell, so I'm not trying to diss the man, but he's very, kind of like peacemaker, very back and forth. who knows if Kevin Warsh is like, yeah, we're making big changes, XYZ, XY. It's possible.
Well,
So
9 of
maybe-
18, 9 of 18 is right down the middle. So you're
Yeah.
still going to have a very divided Fed. And
Yeah.
so that doesn't mean like, oh, there it is. Consensus says they're going to hike rates. It's like, it could be split. But dude, this is a pretty sizable. I mean, we're already outside of the expected move on the day. We're right at the bottom. So if there's more to it, let me see. I'm going to check my open positions here. I didn't get filled this morning because I put in pending orders. But this is exactly why, because I'm like, if we have some volatility, give me some of those pain points. So I'm getting, it's nowhere close to my fill, but I'm going to watch this trade. Let me zoom in here and show you. So this is a broken wing butterfly that I'm looking at today. I'll zoom in. So I'm trying to put this trade in for a 750 credit. I'm willing to take this trade at like $5 or better. So I'd be risking 5 to make 5. Right now I have it set up where I'm risking 250 to make 750 plus $1,000 profit trap. So it's like, I'm going to see a price will come to me. And if it does, I'll take the trade. If it doesn't, then, it's just a bunch of noise. But I put this pain point at my break even would be 7,395. And if we come down to 7,395, that is almost a 2x move on the day. If we expected, I think we had 52 today, 53 points. So if we drop to, let's say 7,400, there's 150. I mean, that's a 2x move, man. The market expected 53 and we got 150. Like, I'd say bring it on. So
yeah,
see.
Chris, I'll raffle through some of my own positions here. I know I already talked about my gold short position. I'm still in that. On this side, we've got a couple positions active here. So I'm short gold. I'm also long dollar in a couple places. I mean, really, that's the bulk of my setups right now. I am short gold, but I am also short euro dollar, and I'm short pound dollar. Both of these are absolutely plummeting. My goodness, look at this. Pound dollar here down 0.5% today. Euro dollar. Pound dollar, I've been sitting in for weeks with this thing doing nothing. So this is nice to see a little bit of follow through.
Okay.
We'll see if it lasts though, right? Like again, it could flip back the other direction. But I like I said, I've been kind of on the dollar bull side. DXY looks good. We're still holding support so far around this 99.4 level. So pretty much all of the positions here looking okay this morning, or at least for now, or this afternoon before the press conference. Alan says, LOL, too late, Warsh. Maybe so. Who knows? I think, again, Chris, to your point, it's a committee, right? Like I know Trump wants rate cuts, but at the same time, it's a committee. It is not a, guy with a gauntlet who can just set the rates. So, yeah, it seems like market, at least for now, is posturing for, maybe let's buckle in and got to be a little bit more patient for these rate cuts. Gold now down 0.7%, silver's down 1.25. Oil's not moved on this, obviously, not necessarily geopolitical. S&P down 0.5%. Nasdaq's holding up okay. I mean, it's down, but it's not. There's no crushing blows to stocks here. I think they're probably just gearing up for what's to come from the press conference side of things. Real quick, guys, also, if you guys are interested in seeing the trades Chris and I are taking, we share them in a Discord server. We have a service that allows you to see every trade that we are taking here. So like I said, I'm short euro, I'm short pound dollar. Let me just pull this up just so you can see it here. Where are we at? Let me find it just to give you a visual example. So anytime I take positions, I share it inside of our Discord. So like I said, I went into this with a couple dollar longs. I'm short euro, I'm short pound, I'm short gold. I'm short everything, man. I'm short bonds right now. I don't know what's wrong with me.
You're a perma bear. What the heck?
I'm a perma bear over here. But again, long dollar. I guess I'm long dollar, but that's, a short proxy. But we'll see. Anyways, if you're interested in seeing the trades that we're taking, if you want to get updates on what we're taking, when we take it, with explanations, breakdowns, etc., we'll drop a link here in the live stream chat to where you can speak directly to a member of our team about setting up a huge discount that we've got going on right now. We're doing 40% off memberships, but during the live stream, we're offering an additional 5% off if you message in using the link that's just been dropped in the chat. Take advantage of those discounts while they are available. If you want to come trade with us, you can also see Chris's trades. He's all over the place trading index, futures, commodities, Forex, etc. So if that is something that you're interested in getting access to, let us know, or head over to our website, a1trading.com. There's your promo. Come trade with us, man. It's we've got some good stuff going on over there.
Indeed. I just posted, so I've got SPCX, so another SpaceX trade out to January. I posted a new trade on JPM or JP Morgan, and then my SpaceX ratio spread. Before that, it was TER, which I think is Teradyne. It's an AI play. Eli Lilly, I really like that one at Eli Lilly. That's probably one of my favorite stocks to actually be holding for the next like 12 to 24 months. I think the pharma space to me is where I think a lot of the, maybe AI improvements will come. Maybe it's R&D, maybe there's some discoveries in there, but it's like GLP-1s, peptides, the weight loss stuff that the U.S. is all a craze for right now. I think Eli Lilly is a big contributor to that. And I mean, Amazon was a bit of a disruptor, but we're right back up to all-time highs on Eli Lilly, so I just did some option trading. It's an expensive stock, I'm not going to lie, but I'm doing it with a margin account, so it's only tying up a couple $1,000, and it's a pretty good trade. I mean, $300, and I'm willing to own it, way cheaper. I'm also going to dollar cost average into the stock with some pullbacks.
Yeah, Chris, do you think the committee is like, with Kevin Warsh coming on, they say new Fed chairs get tested. Do you think that testing somewhat comes from within? I mean, there's a little bit of a hazing effect, right? Like if you're coming into a new fraternity, like you're the new guy, like you're here's the freshman who's
They're like, here's the elephant dance.
Yeah, like immediately I feel like, okay, let's slow the roll. Like we knew what we should expect with Powell. We trusted Powell, and Powell's still in the room, let's remember. So there may feel a little bit of pressure to just be like, not so fast, buddy, because not all these guys, and ladies, necessarily are big fans of the president either.
Well, we have to wonder, like, what is the temperature in the room in regards to behind closed doors? What is their alliance to Donald Trump? Like, truly, as Fed chairs, as Fed members, are they Fed alliance or are they Donald Trump alliances? And I know that there's a blur in there because he is the president. He can clearly influence the market, and he will troll you if he doesn't like you. Yeah. But I do think that they signed up. It's like they let's say there's an oath as Fed member. It's like they still have to stick to the rules that have been in place for many, many decades as like an independent Fed. And I'm hoping for the integrity of the Fed that's true, because Donald Trump has single-handedly also been eroding the reputation of the Fed by just saying too late Powell, too late this, we need to do this, wherever they're wrong. And they've had nothing but criticism for as long as I've been trading. And since certainly the great financial crisis, nobody's appreciated any Fed decision ever.
Sure.
Little do they realize that they're backstopping these markets, whether or not they've engineered bottoms in the market. You should be thanking them the fact that we are at all-time highs versus, oh crap, the great financial crisis just lingered for 10 years. But instead, it's like it was over in a year and a half. 2008's lows, 2009's lows. It's like, yeah, it was an ugly 2-year window. And the Nasdaq took, from 2001's crash to 2013 to get back to all-time highs. That's a shitty time to be in a Nasdaq. But it has been it's still the best performing ETF in the world.
I'm very curious. Again, we'll get the press conference here in a little bit.
Yep.
I don't hear a lot of people talking. I mean, I do, but not enough. In my opinion, one of the biggest things about Kevin Warsh that I'm very curious. He said this in front of Congress. It's his mantra since 2008. He talked about something that is so disruptive that I don't think people are talking about very much, which is this concept of reducing the Fed balance sheet.
I know.
Like, that is so tremendous if he's serious about that. If that is something that is actually within his legacy, he feels strongly enough, because he has said over and over and over, 2008, we did that. We increased the Fed balance sheet, and we should have never, that was an emergency thing, but then we should have walked it back afterwards. And instead, we have lived in an era where the Fed has this ginormous balance sheet. And if he's serious about reducing that, like, I feel like people don't talk about that very much. But if he's serious about doing that, do you like the ramifications of reducing Fed balance sheet is ginormous. It is a huge amount of, to your point about backstopping that the Fed has done over the last 20 years. It's been the Fed balance sheet that comes in, swoops in, and kind of saves the day. That's why I've kind of said, like, if Kevin Warsh is serious about that rhetoric, that is hawkish. Like, that is very hawkish.
Yeah, and that is the liquidity crisis that nobody wants to face. But people are talking about it. People are talking about and again, that's what people talk about for years and years and years and years, Nick, before they're right. But it was on the radar, and knowing that like this is a potential glitch in the new Fed chair and what this regime could be. Like I acknowledge that, yeah, it could be a huge concern, but we will see. Because what's going to happen if the Fed is, let's say that he leads with that, we're going to reduce the Fed's balance sheet,
Right.
Dude. If the market takes it sour and the market's dumping and it's the Fed's fault, guess who's going to speak up and pretty much trash the Fed? Guess who's going to I don't know what Donald Trump and company can do to remove people out of the Fed and get rid of them, but it's like, dude, he stacked the Supreme Court. He can probably find a way to stack the Fed.
Sure.
It's just something that it's like, we'll see. But I think you can say one thing and then I don't know. I think the reality is something very, very different where it's like, I don't know if the global economy or the markets can afford to see the Fed shrink the balance sheet to a point of a liquidity crisis. Because if we do, dude, nobody's going to appreciate the 30 to 50+% drawdown that we deal with. Because when it all pops, if you will, dude, there's nowhere to hide. And correlation is one, and everyone's running for the same fire exit, and there's no way to get out in a reasonable manner. And I think the scary part about this run up is that everyone's in the same stuff. If you're in the indexes, you're all in the same stuff. You are piled into AI, you're piled into tech, you're piled into everything that's been working to drive this market to all-time highs. When that bid goes away, nothing stops the bottom. And no Fed stops the bottom either. Yeah. Right? Especially if they're shrinking the balance sheet. There is no bottom. So we could talk about a Fed put that could be literally 50% from all-time highs. Yeah. And so that's like how I think that's how scary it gets, where it's like, okay, Kevin Warsh, you want to be really serious about reducing the balance sheet? I mean, that's like a president coming in and saying, we're going to drain the swamp. Well, how quickly did Donald Trump pivot from that narrative?
Like, you could simultaneously cut rates and also be hawkish with that. Like, it's a dynamic that's interesting. But yes, you could cut interest rates, which again, I actually think is an interesting scenario, because it actually kind of favors in some ways helping with the wealth divide. I thought that was kind of an interesting, like, cutting rates is good for all parties. It is helpful for people who have lower incomes, who are like wanting to buy a house, wanting to buy a car, etc. Yeah. Fed balance sheet reduction would be wildly unpopular for wealthy people, because it would probably cause the stock market to fall.
Absolutely. It would. But is that I don't know, dude. I mean, we've been led by rich people for a long time. We'll probably continue to be led by rich people. So
probably so.
I think that even if it was like, hey, this is a victory for the average Joe. Okay, but guess what the average Joe gets a victory on? Calamity, deep recession. It's like you're gonna have to, that's the thing, is like, okay, that's great for the average Joe, but guess what? When the stock market crashes and companies start cutting jobs and there's no jobs left,
that's not so fun.
That's not so fun for anybody. Yeah. So there is no victory to come with the wealth effect. There's no victory from any class, where it's like none of it's good. Right. So everyone, the poor can hate the rich forever, but nobody wants to see the market unless you're just like, yeah, bring it on. Let's go doomsday celebrations. I want this. I want the everything to fall and burn, and then we'll rebuild. This is the fourth turning conversation, right? And from some point, like, yeah, we'll have to rebuild from the ashes, but it's like nobody wins in that environment, because if you want wealthy people to get knocked down off their pedestal, that's cool. But if there's no jobs to go work at, or there's no economy left, it's like, yeah, well, you asked for it, and now look at you. Nobody's any better.
The most difficult problem in the world to solve is the national debt and the wealth divide. All that stuff it is a very tricky conversation. And again, we'll see what Warsh chooses to. I think that's part of the reason the market is just looking at this a little skeptically. It's like, okay, what's he going to say? How's he going to set up his Fed committee? There's another thing that's interesting I've heard talked about with Kevin Warsh, which is he has the potential to be the longest ever standing Fed chair. He's a young guy compared to, so there is the possibility that, if he's going to be around for a long time, he's going to be first and foremost, in my opinion, most likely loyal to the Fed and to his own legacy. And a good Fed chair does not just do what the president says. Whether the president is right or wrong and it's in his thinking, the Fed chair's got to act on behalf of the Fed. and on behalf of, theoretically the people, to the best of their ability. So we'll see how it all shakes up. But I think, there's probably going to be the desire to move towards rate cuts. I know he's also been quoted as being very thinking AI is going to be disinflationary, which I think is an interesting take. But I also don't know how confident one can be in that theory. There's so many unknowns with AI. I've heard theories that AI is going to be both inflationary and deflationary. I've heard cases for both. So,
well, energy prices, energy data centers, like that is where I think, like, unless the hyperscalers and the builders are paying their own way, I mean, dude, everyone's been complaining about. I mean, it's funny. Like, I've got friends, like, when I connect with my buddies on Fridays, we play Fortnite for a couple hours. It's like one's in California, I'm out here in Utah, one's in Michigan, one's in Florida, one's in Virginia, and one's in Alabama. It's like the talk of like data centers and nobody wanting them, and it's like it's one person like on the county commission that's approving it, and it's like a huge private equity firm that's coming in and saying we need to build this. It's going to bring jobs. All it's bringing is construction. When that construction is done, there are no jobs to run a data center.
Yeah.
And so it's like you could come in and shake up all this infrastructure and have like an exciting boom for 12 months as it's resurrected, and all of a sudden there's nothing but dust afterwards, and there's no jobs, and it's just higher energy bills and higher suction, and it's going to F up the water table. It's like, dude, there's all sorts of bad stuff that can come with like the environmental effects of just more energy, higher grids, hotter everything. But yet, if AI tokenization is cheaper, well, we can all be entrepreneurs and we can all use AI. It's like, and I'm not hating on AI, but it's like there are, like, you have to respect both sides of the argument where it's like, look, man, we're being promised all this deflation, we're being promised all this ease, and it's not necessarily true. Like our lives might be very much uprooted if we have undrinkable water, insanely high, gas prices, insanely high energy prices. And it's like now home affordability, rental, like everything just goes up with it. Mm-hmm. And I think you have to respect both sides of the argument.
I think I agree. And I think that if you're like, I'm no expert on how AI is going to impact inflation. And I guess, if anyone is going to be more knowledgeable on that, it would probably be the Fed. But even then, the Fed is wrong often on things because the world is complex and it's hard to predict, and there's things that are uncertain. And so, to some degree, I respect both mantras within the Fed too, of wanting to be more proactive and try and move quicker on things. Like, for example, reducing rates in anticipation that AI is going to be disinflationary, but that's a prediction, and predictions can be wrong. So that is where there's also the data dependence type of strategy that Powell kind of got on very strongly towards the second half of his in office term. Being more data dependent means waiting for inflation to show up before you do anything about it. That is why, he gets accused of being too late. But again, it's a double-edged sword because you can never win as the Fed. If you wait too long or you act too soon, both have pros and cons, and everyone points the finger and blames you no matter what. So it's an interesting, it's a challenging role. No one's ever happy with you, but you've got to kind of do the best with the spot you've got. So I think, in terms of Kevin Warsh, I think that if you appease the president, you might unplease, 80% of other parties, which was, a challenging spot.
Don't be a stooge. I'm just like, I think the Fed chair is a really, really big chair to fill. I think it's a big legacy. I think Powell took the high road on all the trolling that he dealt with, and Agreed. I just like don't argue with Donald Trump. Like he's just going to talk. Like he has his own echo chamber, and unfortunately he's the president of the United States who can say whatever he wants anytime, and it's True Social. He's got his outlets. It's like, and people listen, and the whole world is affected by it.
Yeah.
But
when I think
when you're going to get in a pissing contest with him, you're not going to win. He will bully you and wear you down. So you're just like, oh, there's no etiquette here. It is like you're just dealing with a child, and he's not going to back down. Like he'll never back down because he has been empowered to be the president of the United States. So he won't back down, and you can't win an argument because he'll just keep throwing spin and irrationality until you just give up.
I think, Chris, if you're looking at Kevin Warsh's circumstance and situation, he's got a nice precedent right before him. People praised, like you just have, and myself as well, have praised Powell for his handling of what was this is the most powerful person on the planet, and he's coming at you. And it's like, gosh, I could not, even imagine the stress level that comes with that. But I feel that the response that Powell gave, the only keeping it professional, not commenting on it, to the best of his ability. I mean, there's clearly moments where he slipped, but that's a hard spot to be in. Again, where you're getting called out and you are just trying to take the professional approach. I think, at least in my opinion, Kevin Warsh is looking at that as a precedent and saying, that got a positive response from Fed committee members. I need the Fed on my team as the new chair. There is no other way forward. So I think he's probably going to take the same approach. He's going to take the professional only approach. No, he's going to keep personal, stuff as far away from it as possible.
Yeah.
And he's going
but he does have a close alliance and personal relationship with the president and with Scott Bessent. So I think that also puts him in a good situation where it's like, maybe he can push back a little bit and actually have it be respected, as opposed to
fair.
I don't like you, I'm going to troll you. It's like, maybe that's a good thing for Kevin Warsh, is like he can actually say hard things and we don't have to have like a tantrum. It's like we can say hard things, we can agree to disagree, but we can be better off for it. And I mean, look, man, at the end of the day, bull markets are way more fun to trade. So it's crazy to think that we have a Fed chair that's going to step in and take away the punch bowl and drive this market into the dumps. It's like, it's not going to happen. We have a president that wants to see all-time highs because that's his scorecard going into midterms, even though his approval rating is terrible. 37% is terrible.
I think at the end of the day, it's like you said, maybe there's a little bit of a personal, like, we're on the same team.
Yeah.
I may have to disagree in certain ways that
exactly.
attached with, but they might be able to get something done cordially, even if it is like, I could see him continuing that we may have to hike rates and yet still find a way to keep good, relations with the White House in the meantime, and probably just play the minimal political game. And
I mean, if you just say, look, try to do what you can to get out of the Middle East and let oil prices fall a little bit. And we don't have to sit here and have this conversation every month of hiking rates. If inflation would tame itself and we can see things get deflationary, then great. We can stop having this narrative. But if we're going to keep probing things and driving prices up and making this affordability crisis worse, it's like you don't put the Fed in a very good place, other than they're in a corner. They don't have the tools to do anything other than to not let things get worse. And so they're going to have to step in and have to hike. Dude, the whole world is hiking right now. So for us to be the one central bank that's like, we'll pause and we'll cut. It's like, I don't think we can until data improves.
I mean, for weeks you have sent me in Discord.
Yeah.
Chris and I talk on Discord all the time. He sent me several updates of central banks updates, more rate hikes. I mean, we can see it. We can pull up the data. We have it right in front of us. You have the ECB hiking rates this week. If we go interest rates here, I don't know if we have the latest on Europe. Let's see if we do. We might not. So they rose rates. US is probably, well, they did keep rates, so they'll keep them steady here. Bank of England goes tomorrow. I don't think they're going to raise rates, but they're close. Like
they're supposed to pause, but by the end of the year, they're going to hike. Like they're on slots for like 25 or 50 basis points. Most banks are looking at 1 to 2 hikes by the end of the year.
Japan wants to hike rates. We've already been hiking rates. Like, you have a circumstance in which, okay, we are back to a hiking cycle because, and again, I know that the war might be coming to a close, but even still, what kind of damage was done in 3 months of no oil moving, or very, very little oil moving through the strait? Could it be lasting damage? Very possible. Could it be an inflation spinoff that compounds for a little while? Like, that was a problem that we dealt with remember, COVID was not, even when we reopened the economy, there was still inflation that kind of got baked in that we had to deal with for a while.
But it was overwhelmed in the stimulus. I mean, inflation was kind of, we were able to tolerate it because like wages went crazy. When people went back to work, they were making more money hand over fist, and they were side hustling and starting their gigs, and they're getting paid more because they're jumping from job to job. House prices are dirt cheap and rates are freaking dirt cheap. Like, we might never see that stuff again without like another crazy crisis. So the inflation that came of that was too much money chasing too few goods. And now we're in the situation where it's like money just doesn't have the same purchasing power because we've just seen 5 or 6 years of persistent higher inflation. And if you look at the trend, we've been told 2% inflation, 2% inflation. Dude, we've been running with reported data at like 4.5 to 5% inflation every year. And that's we're literally running at double what the Fed is saying. This is our mandate. This is what we're trying to maintain is 2%.
Right.
Like, dude, we've been running like 4 to 5% hot for 6 years. That is why people are mad. That is why people feel like their dollars doesn't go as far as it once did. That's why people are struggling. That's why people live in paycheck to paycheck. That's the reality. So that's the affordability crisis in a nutshell. And people will ultimately vote with their pocketbooks. And I'm talking like MAGA base are willing to defect and say, look, man, this economy isn't working for me. I'm sorry.
Here it comes, Chris. Let me
All right, here we
hold
go.
on.
Let's go.
Yeah, no, I hear you. I was listening, just setting this up. Let me just share my screen with the audio plugged in. Hold on. Boom, boom, boom. I think we're good.
It's the big day, man.
Especially heartened
Can you hear it?
by the
Yep,
warm
we're good.
All right.
of old friends and new colleagues both. And I've listened closely to my fellow FOMC members, heard a lot of new ideas, new thinking, and genuine interest in moving the Fed forward. This week's FOMC meeting exemplified the very best of the Fed's traditions: rigorous debate, open-mindedness, commitment to mission, responsibility, and accountability for performance. In this business, they all add up to one thing: getting monetary policy right, or as near to it as we can do. That is our North Star. My colleagues and I are here to serve our legislative remit, which you've heard us say before: price stability and maximum employment. And these objectives guided our business in the meeting just concluded. As you saw a few moments ago, the committee decided to maintain the target range for the Fed funds rate at 3.5 to 3.75% in support of the Fed's dual mandate. The committee also reaffirmed its policy of maintaining ample reserves in the banking system. Economic activity is expanding at a solid pace, despite elevated uncertainty that owes in part to the conflict in the Middle East. Productivity growth and capital investment, both strong. Job gains have kept pace with the workforce, and the unemployment rate has changed little. We recognize that inflation has been running well ahead of the Fed's long-stated inflation goal of 2%. That's been going on for more than 5 years. Persistently high prices are a burden for the American people. But the recent past need not be prologue. I am pleased to report that members of the FOMC are unambiguous and unanimous. This committee will deliver price stability. At any institution, a change in leadership is a natural and timely opportunity to reaffirm its mission, to review current practices, and to consider whether those practices best meet our objectives. My Fed colleagues and I will be working in close collaboration to ask what changes might improve the conduct of monetary policy. On that score, you might have already noticed something: a difference in today's policy statement. It's a bit shorter, a bit simpler, and it dispenses with some older language. That statement just gives you the facts as best we can judge it. Absent also is so-called forward guidance, which we agreed was not well suited to the current policy conjuncture. This afternoon, you also received the usual summary of economic projections. It's been the practice of this committee for participants to submit these projections, and I have encouraged my colleagues to continue to do so. I, however, have refrained from offering any projections of my own, consistent with my long-held views on the SEP, at least as currently structured. In the median projections, real GDP rises at 2.2% this year, 2.3% next year, and total PC inflation runs at 3.6% this year, 2.3% next year. The unemployment rate stands at about 4.3%. The median participant judges that the appropriate federal funds rate to be at 3.8% at the end of this year and 3.6% at the end of next. Let me turn now to a few words on a key initiative that we're announcing today. I'm appointing a task force in each of 5 areas that are central to the broad conduct of monetary policy. First, Fed communications. Second, the Fed's balance sheet. Third, our use and reliance on existing data sources. Fourth, productivity and jobs in an era of transformation. And last, the Fed's inflation frameworks. These subjects are timely, consequential, and in my view, worthy of a fresh look. My colleagues and I discussed them with energy and purpose over the last couple of days. For each of these independent task forces, I'm enlisting some of the very best minds, both inside and outside the economics profession. They will be supported by subject matter specialists from our superb Fed staff. And they'll have a straightforward charge. Start with first principles. Ask hard questions. Examine current practice. Consider alternatives. And ultimately propose next steps for policymaker consideration. Since last summer, my colleagues discussed possible improvements in the form and function of Fed communications. This new task force will build on that effort, and I expect propose some well-considered changes, including to the SEP I mentioned a few moments ago. The second task force, the one on balance sheet policy, will review the benefits and risks of the current ample reserves regime and the composition of the Fed's balance sheet. They will assess alternative frameworks for the conduct and operation of monetary policy. The third task force, the one on data, will evaluate new information sources and consider methodological changes to improve data gathering, with the aim of giving policymakers more accurate, relevant, contemporaneous, and perhaps most important, actionable information on the state of our economy. Fourth, the task force on productivity and jobs. It'll survey the pace, the reach, the economic impact of new general purpose technologies, including AI, and explore the implications for the Fed in pursuit of our employment and inflation mandates. The last task force, the one on inflation frameworks, that'll examine the drivers of inflation, first principles, and weigh the full range of ideas for delivering price stability in a changing economy. You'll hear quite a bit more about these task forces and this overall initiative in the coming weeks. Enough for now to make a simple statement. Each task force will serve an objective shared by everyone in the system, shared by everyone around that table that I sat with over the last couple of days. A Federal Reserve that is clear-eyed about its mission, fit for purpose, and focused on the future. And with that, I appreciate your attention. I'm happy to take your questions.
Howard Schneider.
Hi, Chairman Howard Schneider with Reuters. Good to see you again, and welcome back. This is a lot to be putting in motion so fast. What is the timeline you have in mind for each of these?
So I think it'll depend on the task force. It also depends on the urgency in which we need clear answers. My expectation, I'm still in the business of recruiting and finalizing them. My expectation is the task forces will begin work in the next couple of weeks, and we'll start to get some more information from them, some more framing of how they see things starting in the fall, and hopefully most, if not all of them, concluding by year end.
And just specifically on the inflation framework, you talk about first principles. Does this include a review of the 2% target itself? You've mentioned that things to the right of the decimal point don't matter. Should this be starting from a premise that 2% as a point estimate is too strict?
Let me break that into two pieces. First, on the inflation framework review, their remit is what are the drivers of inflation? What's the Fed's responsibility for inflation? In part, how do we measure inflation? But that'll overlap with my data group. on the 2% inflation objective, that is the Federal Reserve's long-held objective of 2%. You've heard me say before, I tend to focus on the left of the decimal point. Well, the 2 is the left of the decimal point. For now, 0 is to the right. I see no reason until we have reestablished our commitment and ability to deliver on the 2% inflation objective to revisit that. So that'll be outside the scope of what we're taking on.
Colby.
Thank you so much. Colby Smith with the New York Times. You've in the past said that inflation is a choice, and in the policy statement, it includes this pledge to deliver price stability, as you've reiterated today. But looking at the SEP, the bulk of your colleagues expect core PCE to run around 3.3% by year end, and for the 2% inflation target not to be reached until 2028. So I'm curious how patient you think the Fed can afford to be at this juncture in terms of waiting for one-time inflation waves to wash through and for underlying inflation to step down after so many years of inflation running above target, and under what circumstances you would support the Fed taking some action and raising rates.
Sure. So quite a bit there. Let me try to break that into pieces. First, we have the capability and commitment to deliver on our price stability objective of 2%. That's exactly what we're going to do. In the Fed's review of its strategy over the last any number of years, in January, the Fed, including the strategy that we're still bound by, the Fed statement says that inflation is primarily determined by monetary policy. You bet it is. I've said for years inflation is a choice. You bet it is. And today I'm announcing that this committee unambiguously and unanimously have decided we are going to deliver on that. The rest of your questions sounded like an encouragement for me to give forward guidance. We've dropped forward guidance. Some along the committee, I think, dropped it, I suspect, from our discussion the last couple of days, because they said at this moment in time, it doesn't feel as though providing forward guidance is right. Others have, I'd say, different views and think as a general proposition, forward guidance isn't the business we should be in. But that'll be taken up by the Task Force on Communications and my policymaker colleagues. We're going to listen hard to what the experts say and make our own decision. But I can't give any forward guidance about what we're going to do next. The good news is we'll be meeting in 6 weeks.
So just following up, I guess, on the current policy settings, then I am curious how restrictive you think things are at the current moment, given the flow of data that we've seen and, forecasts that are coming down the pipeline.
Yeah, I've heard characterizations both inside and the Fed about that. I'll give you my own. It's uneven. If I look at the housing markets as one example, Fed policy isn't the single determinant of the state of the housing market. But broadly, I would say Fed policy appears to be somewhat restrictive. I would have a hard time managing to say those words if I were to see what's happening in financial markets. So I'd say it's uneven. That's perhaps a function of different transmission mechanisms of monetary policy, whether monetary policy is coming from our interest rate tool or our balance sheet tool. But the good news, we have a task force on that too, and the balance sheet task force will be looking more at that subject.
You've said you don't like forward guidance. You dropped it from the statement this time, but with the dot plot, 9 members suggested that they want a rate increase by the end of the year, and the markets have taken that as forward guidance. So what does this mean in terms of how you guide the markets and in terms of what the dot plot's future is?
I'm going to have to give you the same answer I gave to Ms. Smith. We've got a task force for that. I'll give you a little bit more. I reviewed the dot plots, and when I saw the submissions, I noted that all the submissions were coming in with pencils, those kind with the big erasers. That's to say that I think my colleagues around the table, when they submitted their dots, understand the world is changing quite quickly. And they didn't feel bound by them 6 weeks from now or 6 days from now in the event that their circumstances change. I'll note a couple other things. What I heard around the table was, as they submitted their modal forecasts, to be clear, this was more likely than not. This was more likely than their other scenarios. So I didn't hear tons of conviction. What I heard was the kind of humility that I think we should have. I did not submit a dot. For me, it's not helpful in the conduct of policy. I suspect by year end, as I mentioned in my opening statements, there'll be a review about communications broadly, press conferences, dots, meetings and the like, transcripts, minutes. This will be part of that. I don't want to prejudge the outcomes there, but I'm pretty open-minded about what they could be. And I was just incredibly impressed over the last couple of days. My colleagues over the last 2 days, and frankly, over the first 3 weeks I've been here, they've been very open about changes. Change isn't easy, change is filled with risk, but our number one goal is to get monetary policy right. The way to get monetary policy right is to deliver on the remit that Congress gave us, to deliver on price stability. And there was no disagreement on any of those points.
At the risk of possibly getting the same answer about task forces, communications, what is your feeling about these news conferences? Are you going to continue one after every meeting? Do you find them useful? What is the future for the way Kevin Warsh will communicate?
Well, this one's probably got another 15 or 20 minutes in it, so I don't want to prejudge the outcome. Press conferences can be a very useful way to communicate with households, businesses, and more broadly through using the likes of you. I had a great old mentor named George Schultz, and his mantra was press conferences are useful, but when you have one, you want to make sure you have something important to say. Today, I think we had something important to say about our commitment to deliver on price stability, our commitment to rethink practices with an eye of moving the Fed forward, and to give you and the American people a sense that these aren't idle thoughts, these are concrete thoughts, that we're going to seek out the best minds, both the best thinking inside of the Federal Reserve and the best people I know in business and economics and the academy and technology and the rest to share their views. That's what we're going to be doing here, the pursuit of truth. I think we're going to come up with some new and interesting things. We made some changes today. I expect more changes to come. And some of those might well be worthy of a press conference.
Chris, your favorite.
Hi, Chris Rugaber at Associated Press. Thanks for taking our questions. Could you give us a sense of how you see inflation more in the long term? I know you may not want to comment on the ups and downs, but is this mainly driven by energy prices in the Iran war at this point, or do you have any concerns about underlying inflation pressures in the economy? Thank you.
So I can't do much better than the committee just did. So let me restate it. Inflation remains elevated relative to the committee's 2% goal, in part reflecting supply shocks that have driven price increases in certain sectors, including energy. The paragraph goes on to say, but to be clear, the Fed will deliver price stability. My own judgment is the committee spent quite a bit of time, not just in 2 days, but over iterations of a couple of weeks. That's what we're prepared to say about inflation, but the commitment to deliver is strong, unanimous, and unambiguous. And that's, I think, an important message. We've missed for 5 years, and we're going to fix that.
Well, great. And then just on the data task force and everything else, I mean, generally speaking, I think people feel the Fed looks at everything already. Certainly that was the sense from before. Is there data that you feel is not given enough weight? I mean, you mentioned the trim to mean in the past, but again, that's well known to certainly most Fed members. So what is that task force looking at, and what might be I mean, I know you don't want to prejudge the outcome, but are there examples of data that you expect might be given more weight? Thank you.
So you're answering my question. So let me say, I don't want to prejudge the outcome. I also don't want to say too much about what they're going to do because I still have a phone call or two to make before I've nailed down the people that are doing that. I'm interested in what the outside experts' view is on the subject. I'll say this generally. Most of the data that central bankers and other government officials in the United States consume come with old-fashioned survey methods. A national accounts of what the U.S. economy looks like that looks very little like the U.S. economy in 2026. Survey methods that don't have response rates that we need, asking questions that might have been quite applicable a generation ago that are less applicable now. So even inside of official statistics, I would be open-minded if the task force and our own best thinking had recommendations how those official statistics can be brought up to a standard of our time using new analytic methods. I'd also say this, almost every private company CEO that's running his or her business are doing so with real-time information that isn't subject to much revision, that is telling them what just happened at that very moment. As you know, there are normal, long and variable lags in the conduct of monetary policy. What we're really interested in is what's happening right now. What we're less interested in is echoes of history. And you're hearing from my answer that some of the data that we receive, that we're waiting on, the first Friday after the month, the payroll index or something else, that might be an echo of history that's quite useful on its third revision. We need to take those error bounds down because we have to make hard decisions in real time. I'm really open-minded that there is a lot of new data sources that we can learn from the private sector, from reforms in the official sector, and new analytic techniques that are far more refined than asking a simple question about whether something was core or non-core.
Edward.
Thanks. Welcome, Mr. Chairman. Edward Lawrence with Fox Business. So if you don't give a lot of ongoing forward guidance, won't the markets have more volatility, and shouldn't Americans have more access into what you're thinking going forward?
So I think financial markets perform best when they react to incoming data. I think the financial markets work less efficiently when they ask a question, how will the Federal Reserve react to that incoming information? The more that markets are paying attention to what's happening in the real economy, deciding what's good data and what's less good data, the more financial markets can price what they believe is the most likely and what are the tail risks. Financial market prices are probably the most important source of information to guide central bankers. But when all the financial markets are doing is reflecting back what we've said, then we're taking the most important source of information and we're being blind to it. I'd like us to create a system where those blinders come off, where markets are following data that they efficiently think is reliable, and they'll be watching data, we'll be watching data. They'll come with better information through market prices to us. We can make more informed decisions. But ultimately, the goal that I said at the outset, deliver on the price stability objective that Congress told us to do, and that we've got to get in the business of doing.
Yeah, if I could take you in the meeting a little bit. This is your first meeting. The board members seem fairly hawkish when you listen to, in general, when you listen to what they're saying. Was there any discussion of a rate cut going forward today?
There was one proposal on the table. There was no discussion of any other proposals. The discussion on that proposal, I would say, was quite limited. The group was unanimous and unambiguous on it. It has been the practice of this central bank and others to have a range of alternatives. Today we had one. I thought it furthered discussion, deepened it, and made it clear what we needed to do and how we needed to deliver. I wouldn't prejudge what happens in the future, but there was only one big subject for us. We took it on. We had a good family fight on it for a couple of days, and we ended up, I think, in a better place.
Claire.
Thanks a lot, Claire Jones, Financial Times. Coming to this blind, reading this very nice short statement that I think we've all appreciated in the room, one might wonder why you didn't raise rates today, considering what you're saying here about the risks to US inflation and your mandate. I guess, why not, and what would you need to see in order to get to that place? And secondly, on your task forces, are there any best practices at other central banks that you'd consider looking at? Thank you.
Yeah. I'm glad they're in the practice of giving you two questions, because my answer to your first question was going to be very curt. I've got nothing more to say than the statement itself. And to the point of the question I got before, market reactions to what we say unfiltered, I think is more helpful than having delivered a statement, me then improvising further upon it. Best practices of task forces. This is a subject I've thought some about. I've been on a task force or two in my life. Best practice, find the best minds. Ensure that the task forces have a range of people, both by backgrounds and predispositions, so they too can have a bit of a family fight. Make sure when you establish a task force that the group that's going to be the recipient of the information feels as though they've got some equities in it too. That's why we're looking for, haven't done the final roll call, some of the most significant talent we have in the building and across the reserve banks on each of these, and in some sense seconding them to this group for a period of some number of months, so that the leaders of the task force know what the most analytical central bank in the world thinks about that. They can reflect on it. And a final best practice, we're not outsourcing decisions to anybody. Administrations past and present, reserve banks have chosen a group of 19 people around the table. These will be our decisions. We can agree to some of the recommendations, disagree with others, have a good family fight about it. But what comes from them will, I hope and believe, make the discussion we have internally better, stronger, more of a dialectic, so that we can finally deliver on that price stability objective.
Just a quick follow-up on your markets point. If you look at 2-year yields, they're really suggesting that markets think more tightening is needed. Would that be your read on what the 2-year yield is saying as well?
We were in such a good place. This is why we don't do third questions, I presume. I'm not going to offer any commentary on market reaction over the last 30 or 60 minutes. What we've given markets is a new chapter for the central bank, some fresh thinking. What we've given markets and households and businesses, I think, is a commitment to ask ourselves hard questions such that we can deliver on the promises that we've made before. This is a lot of change for financial markets to digest. I wouldn't be particularly intrigued by how they react in the first several minutes or even first several days. What I think is most important is that financial markets, and at least as important, households and businesses know that this central bank will deliver on price stability.
Hi, Chairman Warsh. Brian Chung with NBC News. Thank you for taking our questions. So when you say that we've dropped forward guidance for the layperson, that might sound like the Fed's going to say less or offer less insight into where their borrowing costs might go. So for the person that maybe you might run into at the grocery store, where the price tags are rising at a faster pace than their wages at the moment, how would you explain it to them? I don't know if task force might be the answer there, but how would you kind of communicate this era, this chapter of the Fed?
If I told somebody in the milk aisle that I had a task force for that, I think that would be doing a very poor job. So I appreciate it. If I saw somebody in the grocery store, what I would say to them is that we cannot have a very significant effect on particular prices. The price of oil in the markets today, or even the price of a dozen eggs, that does not have first order consequences to what we're doing. But we do have a really important job there. And it's to make sure that those changes in oil or beef or eggs or milk don't broaden in the economy, don't have second and third order effects. That's our job. That's our commitment. That's our capability, and we're going to deliver on it.
And then is the Fed's relationship with the Treasury also under review? There was the normal breakfast meetings with the Treasury Secretary. Is that something you intend to continue doing? And have you had conversations with the president since you're swearing in?
So on the president, I don't have anything for you. With respect to the Treasury Secretary, he has been posting pictures of our breakfast. So I don't think I can deny that. The long tradition at the central bank is that the Fed chairman and the Treasury Secretary meet weekly. I think we've pulled off 3 of those so far. I believe he's overseas this week, so this will be the exception to the rule. I think they're very useful discussions. The central bank's objectives and our roles and responsibilities are quite delineated from the fiscal authorities. And in my view, monetary policy is independent in the conduct of what we do. But that doesn't mean we're not interested in what's happening with the fiscal authorities. The way I think about it is this central bank needs to have a wide lens, but a narrow remit. We need to be quite interested in what's happening in the world. I won't be breaking any news here to suggest I'm quite interested in what's happening in the Middle East. that does have some effect on our day job. It doesn't mean it's our responsibility, but I think we're going to keep a wide lens, and my meetings with Secretary Besson to this point have helped widen that aperture. So we're aware of things that could affect our day job, even if it isn't.
Steve Leisman, CNBC. Mr. Chair, thank you. Mr. Chairman, thank you for taking my question. You had
Chris,
said in the
peace out, man. I gotta go.
You became chairman.
Thanks, dude. It's been a good session.
Yeah, for
a
sure.
Reason why the Federal Reserve could lower interest rates. Do you still believe that to be the case?
So the committee had a discussion of productivity today. AI came up. The way I thought about it before and socialized with the group is that artificial intelligence, the latest generation of general purpose technology, is perhaps as important a change in the economy and business and households that we've had in my adult lifetime. It is filled with both a huge opportunity and with risks. I take both of those very seriously. You may have heard me say before that AI is shorthand perhaps for American ingenuity. That doesn't mean that it's going to be easy. That certainly doesn't mean it's not going to be disruptive. But over the long term, my conviction, and I heard quite a bit of support for this around the committee today, is the United States is a winner as we go down this. The United States is ultimately going to be better off in that. Now, to bring that back to the conduct of policy, timing, scale, speed, implications for output and employment, it's one of the things we have a task force to do.
If you don't mind, a follow-up from the other side, which is that when you look at the strong job growth that's out there, the elevated inflation, GDP seems to be going pretty good, and the stock market seems to be soaring. Do you look around this economy and see the funds rate being restrictive?
So that's your second question. I'm going to give the same answer that I gave before. I'd say as I think about the conduct of policy, what matters is what's the effect of policy. Not what do we say, but what happens. And the best way I can describe it is it's uneven. I do see some restrictiveness in things like housing. It's hard to use those same words anywhere else. I'll just make one other point. You talked about one of our dual mandates on the employment side. I don't believe that we have a cruel choice. I don't share the view that was expressed a few generations ago that Federal Reserve chairmen show up at a podium like this and say, you got to choose. And you're going to have to decide whether you're willing to tolerate higher inflation to put more people at work. I don't believe in that. What I believe is if we do our job, we can make strong growth, low prices, and strong employment mutually compatible. And so what you heard from the committee today is we've got some work to do on the price stability front.
Nick.
Thank you. Nick Timmeros with the Wall Street Journal. Chairman Warsh, you've said repeatedly credibility is earned by delivering. If credibility requires delivering, the move would be to tighten or at least to threaten to. Now, you didn't do that today. Why not?
That judgment you expressed was not expressed by any of the 19 people around the table. We'll be meeting in 6 weeks. We'll take up the issue again.
And if I could ask about AI, the build out is generating enormous demand right now, CapEx, data centers, power. The productivity payoff may be further out. So in your judgment today, is AI adding more to demand or to supply?
It's a good question. At the central bank in an economics profession, what we spend most of our time doing is counting demand. It's easier. We can see it, we can count it, we can check it, we can revise it. What we do, though, is we infer supply. You'll notice in the second paragraph of what one of your colleagues described as a very short statement, we have a sentence on the demand side and a sentence about the same length on the supply side. They're both important. Just because we can count one better than the other doesn't mean we're going to favor one more than the other. With respect to AI and the growth of data centers and infrastructure around it, we're counting the demand side, and it is no doubt showing up in GDP figures. We can be less certain when we infer the timing and extent of the growth in the supply side. It may well be an intuition the supply side is going to expand, but it'll take longer. I just describe it this way. There's a race between supply and demand. Milton Friedman says that the only thing we know about economics is that there's a supply line and a demand line they ultimately cross. When they cross and what are the implications for policy? The good news for you is we have a task force for that.
I love it.
Thanks, Mr. Chairman. It sounded
He's
like
funny.
On the task force on data that you were looking at overhauling or completely overhauling the system of national accounts, the way the government mines the economy. Is that your ambition?
In a word, no. In a few words, much of this data gathering happens in other government agencies to which we owe a tremendous amount of respect, tremendous amount of deference. But if in the course of this, we come up with recommendations, which Fed staff have already begun to develop about things that they could be doing to help inform us as policymakers, we're not going to hesitate. Again, I don't want to try to delineate the four corners of the research of the task force on data, but I do think there will be a review of official statistics, and at least as important, a view of bringing the best practices from the private sector and new analytical tools made possible by AI so we can forge these into a fabric that gives us better real-time information. So as I mentioned before, when we're making decisions that we'd say are real contemporaneous data, not data that we call contemporaneous, that's really an echo of history.
Okay. Thanks. The other question I wanted to ask is related to the building renovations. Are you considering any changes to the renovations, the projects, just in light of the fact that they became kind of a political football in the last year?
I heard something about that. I don't think I'm breaking any news, but my view, when you show up at a new institution, you should go meet with the inspector general, just as a matter of good practice. It's a practice that I hope to continue. I've had one meeting with the inspector general, and he told me what I believe the world knows, which he'll be coming out with a report on the building and the building projects at some point later this summer. I'll be interested in reading the report. From my perspective, with a forward-looking glance, is there anything that we can be doing or should be doing from this moment until the completion of the project to do what we can to be good stewards of taxpayer money and make sure that we're delivering on the promises that we made? Some more work to do. You might not be surprised in the first few weeks. I've been somewhat preoccupied on other matters, but I promised it to get to the full breadth of the Fed's tasks in the weeks ahead.
Victoria.
Hi, Victoria Guida with Politico. So I know that you did not submit a forecast, but you are the person who is authorized to speak on behalf of the FOMC. So I'm wondering if you could tell us in the SEP, the increase in the expectations for inflation, is that all because of the Iran war? What was the discussion around what would the expectations for inflation being higher and also potentially growth being slower?
So my read of what I heard in the room reflected, I must admit, in the SEPs, is half of my colleagues thought the policy rate, given all those developments, should be at this level or lower between now and year end, and the other half thought higher. That 19th voter was me, and I didn't submit one. There's a range of views on the questions of first and second round effects, no resolution or conviction, but we'll be meeting again in 6 weeks. I think we're going to know more then. And I think that my colleagues are very attentive to incoming developments between now and then.
And can I just quick follow up on the SEP? You said that you're still encouraging your fellow committee members to submit forecasts even if you're not doing it. So what do you think is the benefit of them doing it even if you don't?
That's the commitment that the FOMC made, and it's a commitment that I hope we live up to. Commitment we made was to deliver price stability. I expect us to live up to it. By the time we get to the end of this year, as I mentioned, I wouldn't be surprised if there was a new communications framework. There were some changes to the SEP. That's a committee discussion, a robust discussion. I think we'll have it. I believe we're going to come to a better mix of communications to deliver on what we promised, but I wouldn't want to prejudge what those are. But between now and then, I would continue to expect colleagues to submit their SEPs. Some of them, I think, believe that the practice is currently structured is okay, but I heard a lot of interest in real reform, generally about all these topics. You didn't ask it, but I'll answer. It was a pretty gracious couple of days, and it's been a pretty warm few weeks. The institution wants to figure out how we can do better. The institution's going back to first principles, and I'm encouraged that what we've done in the statement, what we're thinking about doing with respect to the SEP, that instinct towards a new chapter is a real one. And by the end of the year, I hope we can put some points on the board, both in form and in substance of delivering.
I'm going to end up for the last question.
In Bloomberg News. Could you guide us through, please, some of the principles that guide your own reaction function, and tell us a little bit about kind of conditions that you think when the Fed should respond?
It's going to be a very unsatisfactory answer to the final question. The Federal Reserve has a lot of responsibilities, not just in monetary policy, but in supervision and regulation, consumer affairs, and payments. My own view is our credibility comes from delivering on what we're saying we're going to do across everything we do. I've devoted more time in my first 3 weeks to monetary policy than all those things. But the more we deliver on our promises as good supervisors and good regulators, the more benefit we get, the more credibility enhancement we have in monetary policy. When we deliver on our price stability objectives, which we will, the American people will feel as though the hardships that they've been living through, in part because of inflation the last 5 years, are in the rear view mirror, and that credibility will have dividends across what we do. And the institution will come to press conferences like this, always with an impetus to reform, always with an impetus to do better. But we're going to put some points on the board.
Mr. Chairman, strong labor data in recent months, how would you sum up the labor market right now? Do you see it as stable and as potentially a source of inflation? Thank you.
Yeah, so the committee, if I were to try to capture how the committee thought about it, the committee thought that the labor markets were stable. There were some people around the committee who thought that it was trending better than that. Trends matter more than data points. What's happening over 3 or 6 months matters more than any one data point, any one data release. And I'd say the jobs data has been moving in a good direction. If I heard one other thing around that subject over the course of the last couple of days, what I heard was that strong productivity-led growth is not something that we fear, but something we embrace. Thank you all very much.
All right, there you have it. First Fed chair meeting in the books here for Mr. Kevin Warsh. Interesting reaction, some interesting notes. Every Fed chair seems to have like their phrase that they say over and over. So task force certainly takes the cake today. Task force 101. I need a task force for keeping up with how many task force there's going to be. Anyways, reaction overall, just taking a kind of scorecard look here. Stocks moved lower. I mean, to an extent, we now see Nasdaq kind of bouncing. Not really a huge move on stock side of things. However, dollar very clearly moving higher here. Gold lower, silver lower. Yeah, very, very interesting take there. I think that the lack of forward guidance is an intriguing concept. And I think also his point about kind of being, he said a specific line. He said, financial market prices are the most important source of information to guide central bankers. What I hear out of that, long story short, is they're going to watch what the 10-year yield does. And they're going, or let's say the 2-year yield. And this tells you, I mean, from the man's statement, he's saying, I mean, let me read you again what he said, word for word. Financial market prices are the most important source of information to guide central bankers. I mean, if you are looking at prices in the markets for central bankers, there is no more holier than this in terms of the holy grail of Fed monetary policy trackers, the 2-year yield. And the 2-year yield today is reflecting up. What does that mean? Hawkish. So if your strategy is to follow the 10-year yield, the 2-year yield, which I think is decently a strong opinion or a strong strategy, to be honest. The market's really smart. This is basically saying follow what the market's suggesting. Then this is telling you rate hikes. Like, that is what this is telling you. That is telling you rate hikes, not rate cuts, are the summary here. So when do we decide his tie color equals forward guidance? 9 out of 18 participants expected a rate hike in 2026. We're going to need a task force for that. Yeah, really interesting. I think, again, he had a couple opportunities to take the very progressive take in terms of monetary policy, forward guidance, et cetera. He kind of declined it. Like he didn't come out swinging saying, basically for example, he got asked point blank, currently on inflation, do you think the Fed is restrictive? And he could have taken that opportunity to say, yes, I think we're restrictive. And ultimately, I think that will come out in time. He could have said that. He didn't. Right. So there was some statement there. There was some open doors to be more dovish than he was, and he declined to go through them. So I'm going to go ahead and say that I think that was a more hawkish than expected wash. Gold is moving lower. Dollar is ripping higher. Today's a good trading day for me, guys. If I could just copy and paste today's movements anytime I wanted, it would be nice for trading wise. Gold's lower, very nice. I am short gold, probably going to trim my stop today. I'm going to probably reduce my risk on this trade. Same with euro. Euro looks fantastic. I think we just hit target on the first one. Very nice. Pound dollar, brothers and sisters, that's very nice. Look at that, rolling over nicely here. Dollar strength coming back into the picture. Congrats to the dollar bulls, man. That was a win. Look at that. We're back to highs. We are back to highs. That is a monstrous green candle. Let's see if it sticks, though. I mean, the thing is, if you've traded dollar for a minute, if you've traded dollar for more than a minute, then you probably know where I'm going with this. We know very well, doesn't matter if you're bullish or bearish. If you've traded a dollar, you know real well that this thing loves to fake you out, loves to go one way, look real strong one direction, and then flip the other direction. I generally remain bullish on the dollar. I have been bullish on the dollar for several weeks. I think you have high inflation. I think you have rates on the move higher. I mean, today's move in rates is very reaffirming of the idea that the Fed, but interesting. I want to read something with you guys here. Take a look at this. 30-year yield is lower. Okay. So 2-year yields higher, 10-year yield is higher, but by less. And the 30-year yield is lower. What is that telling you? Well, it's telling you long-term expectations for the Fed are for rates to not necessarily move meaningfully higher. But in the short term, the expectation for the Fed is to move rates higher. Okay. Keep in mind, for potential deal to be signed today, right as we hit 100.5. Alan, that is a very good point. We have DXY sitting right there at those highs, almost ripe for the deal to get signed and smash that back down. That being said, I am partially taking profits on that euro dollar move. I believe I'll have to check my position shortly. I'll update you guys. Guys, we are on fire recently with some of these trade ideas. If you're not in the Discord and would like to be, here's how you can join to get access to trade alerts being shared by myself, by Marco, Chris Pulver, Ivan, our crew here. If you are interested in getting access to these trade alerts, we'll drop a link here in the live stream chat to set that up so that you can get notified and trade alongside the rest of the gang here. Alternatively, actually, if we could just drop that link there. Boom. There you go. Got a double whammy. If you guys are interested in setting up access to the VIP group, click here, chat for extra discounts. That is available right now. We're doing 40% off our memberships. So if you're interested in trading us, there is no better time. That is a huge discount. I think, oh, and also let me change this. Stream viewers while we're live get 45% off if you chat in using the link that just got dropped in the live stream chat. So we look good here. I mean, Eurodollar taking partials on this. I mean, my goodness, that is a monster candle. Look at that 4-hour candle. That's unbelievable. Pound dollar down 1%. This 4-hour candle is down 108 pips, man. Gold's down 2%. Okay, now stocks are actually making a follow-through move here. Everything's coming down now. Nasdaq's down 0.5%. Dow Jones down 0.7. I mean, this is impressive that the Nas is not down more than that. That is pretty impressive stuff. Stocks are down 1% on the day. You've got Nas down 0.5. It's got to be semis, man. The undefeated. Yeah, look, semis are still up 2% on the day. Semis are undefeated. Anyways, yeah, just going to manage this position. I'll update you guys inside of the Discord. If you're a member in there, keep an eye. I've got to do some adjustments to my positions. I need to trail stops on gold. I believe I've locked in some gains on the dollar longs, euro dollar short, pound dollar short. It's a good day, man. That's a nice little sell off. And I think, you never know with these things exactly how they're going to go, but I have to brag for half a second. I have been saying for a while that I think Kevin Warsh is going to come out sounding more more hawkish than the market gives him expectations to be. Like, I think he is more of a hawk than people had kind of chalked him up to be. Okay. We'll see from here. It could be that he's got new guy effect and he's playing his cards slowly. So we'll see. Anyways, guys, like I said, join us on Discord. I'll share some updates on that. We do have a free Discord too, by the way. If you guys are interested in the free Discord, boom, scan the QR code right there. You can join the free version. And if you're interested in getting access to the VIP side of things, you can always sign up for that later. We have a free chat room available inside of the Discord. We'll also maybe drop the link here in the chat. There it is. Boom. Free Discord is available there. I'm going to give you credit. Everyone was against your idea and boom. Well, the thing is, D-Money, I appreciate that. I'm wrong often. And every trader is. Every single person here is wrong often, whether you recognize it or not in terms of closing out positions quickly or closing them out slowly. The markets are just very difficult to predict. All sorts of crazy moves happen. And so we're all wrong often. What matters is when you're wrong, what do you do about it? And when you're right, what do you do about it? How do you manage the ups and the downs? That is what matters ultimately. Like, I have wrong ideas all the time. So that's why, I never really worry too much. Like, I'll get a comment all the time, like, Nick, you were so wrong about this, or you were so right about this. It doesn't matter. The one trade does not matter. It matters, okay, if I take the same setup 1,000 times, am I going to make more than what I lose? Because I'm going to lose some. Like, it's a business model, right? You're going to pay, you have expenses in a business, you have expenses in trading. That's your losses. You also have revenue coming in, which is your profitable trades. Is that going to exceed your expenses? That's all that matters, right? Nick, I bought a few of your products and have no regret at all. You're the best. Thank you very much. I appreciate that. I appreciate your team as well. Yeah. Team's fantastic. Yeah. Again, guys, I'm telling you what, we offer authentic tools. VIP membership is a wonderful place to learn, to meet other experienced traders, to get involved with a group of people that actually do this stuff, right? There's a lot of noise out there. There's a lot of nonsense, a lot of stuff that, is not, no verify. I show all the time my real personal trading portfolio because I think it adds credibility to people who are interested in a service. I know what it's like to be on the side of the viewer and be like, I have no idea who I can actually trust, who I can actually learn from. Like, I want to see somebody who trades and shows their portfolio. I've done that not just because I think it's the right thing to do, but also because it's a major, major improvement to the success of my business. Like, transparently, we sell stuff. We sell more stuff because of the transparency factor that we try and produce. We show people P&L. We show people when things are going right, when they're going wrong. It adds a layer of, legitimacy to what we do. So anyways, with that said, we're going to end the stream there. I'm going to try and get a quick video out covering what we just found out about. So stay tuned on that. Make sure, if this was your first time here, guys, make sure to subscribe, hit the thumbs up button. We do this for major economic news releases, future Fed events, earnings reports that are really notable. So make sure to subscribe, hit the thumbs up button, follow wherever you are. If you're watching on Twitter, YouTube, etc., come back and hang out with us more in the future. Last thing I'll tell you guys, because I worked on it for a couple hours today. First of all, check out this new homepage video. Shout out editor, looks good. Whoever this guy is, very 10 out of 10 attractive guy. Anyways, check this out. If you go to under prop firms, we have all these discounts we've been finding and posting up on our website with prop firms, but I've got something even cooler. This table, if you are looking to get funded, check this out. I'm gonna drop the link here in the chat. We are putting together a table that will help you to get the lowest possible prop firm prices. Okay. We are bringing all these prop firms into our website. They all want to be posted up on our site. And what we're doing is, let's say you're trying to go for, I don't know, a 50K account, right? We currently have a couple prop firms. We're adding a lot more. Let's say you want to do a two-step and you trade Forex/CFDs. What this does, this tool will help you to scan for lowest possible challenge prices and discount promo codes. So we've been working on this page. We're overhauling our website right now with all sorts of free, helpful tools. Take a second, check this out. If you choose to use one of those, they are referral links. So full transparency, I'm not, they help out my business. It's, a free thing to you, but it helps out if you choose to use our promo code, etc. But we're trying to build some tools that help people to get the best possible prices on prop firm challenges. So if you're interested in trading prop, check out this tool we've been working on. We also have a couple other free tools that might be useful to you. Like, for example, this free position size calculator that we've been building. So we have some free calculators on here. We have some reviews of different props that we have. We have all these different calculators that we've been adding to the site. And we're going to be doing some giveaways on the site. We have a bunch of sponsors who want to give away stuff to subscribers of our website, etc. So again, head over, bookmark A1 Trading. We got a lot of cool stuff coming on that side of things as well. Guys, that's all I've got for you. Thanks for watching today. Hope it was helpful to you, and we will see you back on the next one. Cheers. Have you ever wondered how you could find more trades like this gold runner, or the S&P 500 breaking out to all-time highs, or this sell-off in dollar Swiss franc, which was a clean short opportunity? Well, all of these charts shared one major thing in common. They all had powerful macro fundamental catalysts driving price decisively in one direction, presenting a really strong trading opportunity. Hi, my name is Nick. I'm a 10-year trading veteran and the founder of A1 Trading, where we build market scanning software that help traders to track macro fundamentals, crowd sentiment, and the commitment of traders' data to best understand where institutions are moving their money. Our tools automate everything from studying jobs market data, inflation statistics, and economic growth metrics, bringing it all together into a scorecard or rubric that helps to spot better potential trading opportunities through our insights offered by the tools. So if you're looking to access our tools, stream viewers get extra discounts, and we're currently offering payment plans as an option for those who would like to split up the cost of our tools into a couple monthly payments. Alternatively, we also offer a free Edge Finder tutorial course, as well as fundamental macro course that can help you to learn the concepts behind the tools. Scan this QR code that you see on the screen right now to be connected with a real person from our support team. We have helped thousands of traders level up their trading through insights, dashboards, and automation. And we are passionate about this subject because having the right tools that hedge funds and proprietary firms keep locked in key is a powerful game changer for the average everyday retail trader. To explore our products, payment plans, and just to find out more and speak to a real person about this, scan the QR code that you see on your screen right now. Alternatively, the link can be found in the live stream chat or in the description of the live stream. On our website, you can find a collection of both free and premium trading tools that our team has put together to help traders take their trading to the next level. Well, you might be wondering, how can your tools help me? Well, whether you're a swing trader or a day trader, our tools are meant to help traders of all different levels of skill, time frame, and traders that trade Forex, commodities, indices, stocks, etc. At the core of it is automation, simplicity, and bringing it all into a one-stop shop for you to scan markets more efficiently and build a curated watch list of potential trade ideas. So regardless of what you trade, we hope that our website helps you in some way. And if you have any questions, feel free to contact us using the contact button in the top right or the live chat feature available on our website. We also offer free courses on fundamental and technical analysis on our website, as well as a range of free tools like, for example, our risk calculators that can help traders to level up their trading without paying a dime. Our goal is that our tools and site help you in some small way, and we wish you the very best in your trading journey. Thanks for listening.